This is Al Brooks, and this is my price action trading course. The current module is about breakouts and gaps. So what exactly is a breakout? It is the strong phase of a trend. A trend can either be in a spike, which is also a breakout, and a strong trend, or it can be in a channel. These three terms, spike, breakout, and strong trend, are three different phrases to describe the exact same thing. So what exactly is a breakout? Remember the market cycle. The market goes from breakout to channel to trading range and then another breakout. The breakout is the strongest part of the trend, the initial part of the trend, and it's followed by a channel, and that evolves into a trading range, and then there's a new breakout. Every trend bar that you see on the chart is a breakout, and it's also a spike, and it's a gap, and it's a climax. I'll explain that later in the module. What can a breakout look like? It can be a single, unremarkable trend bar, and it could lead to a big trend. It can be a large trend bar. It can be a series of big trend bars or small trend bars. And a breakout of what? A lot of times beginners won't see what the breakout is from. An obvious thing would be a trading range. Another would be a pullback within a trend. You can also break out above a trend line, and you can break out above or below a moving average. A breakout can simply be moving above the high of the prior bar or below the prior bar, or above a prior high on the chart or below a prior low on the chart. What happens if you don't see what the breakout was from? It really doesn't matter. If you see a trend bar, there's a breakout. And with experience, you'll be able to see what the breakout was from. Understanding breakouts and how to trade them is one of the most important skills you can develop as a trader. Breakouts, when strong and successful, usually have a second leg. So in other words, once the market breaks out, there's a pullback and then a second leg. And they often go for some kind of a measured move based upon the size of the spike or the size of the trading range from which they broke out. And breakouts often fail. And traders all the time have to decide what to do once they see a big breakout. So for example, if there's a news report or an earnings report on a stock, and the stock opens with a big gap up, you'll hear traders on television like Fast Money on CNBC. I don't get any money from Fast Money. I'm just mentioning them because it's a popular show. You'll hear the traders say, big gap up on news, do we sell it? And you're saying, wait a minute, why are they talking about selling a big gap up? Shouldn't they only be talking about buying? Not necessarily. They'll look at the big picture. They look at all the bars to the left. If the market is in a very strong bear trend, they'll assume that the breakout is just a buy vacuum up to test resistance, like maybe the top of a channel, and they'll look to sell. You'll also have other traders who'll say, big gap up, maybe it'll break out above the bear channel if it's in a bear trend. What a great opportunity to buy on strength, expecting follow-through buying. And neither the bulls nor the bears are all that certain. Remember, the 60-40 rule, most of the time the probability is between 60 and 40%. And that is really true. Anytime the market gaps up big, the market's trading, there will be institutions buying and other institutions selling. And you have to assume that both the bulls and the bears are profitable. Most institutions are. And how can both a bull make money buying and a bear make money selling at the same time? It's because of trade management. If they look at the big gap up, they'll say, I don't know, maybe 50-50 chance it'll go up or down. They will have to risk half of what they're going for in terms of reward. They'll have to decide where the protective stop is, and they'll have to go for a reward at least twice as big. They don't specifically say, oh, what do I need to get a positive trader's equation? How big a reward do I need for a positive trader's equation? And that's not what they do. They look at worst case stop, and then initially they'll go for a target twice that size. If the market starts to go their way without getting anywhere near their stop, they'll take a look at how far the market went against them before it started to resume in their direction. At that point, they'll base a target on the actual amount of money that they had to risk on the trade. One thing you'll never hear traders say is, oh, it gapped up and now it has a hanging man pattern or a dark cloud cover. Okay? Traders are not interested in that stuff. It's nice, right, to have a signal bar. It's much more important to have context. You know, where are you in the market cycle, and is the market at support or resistance? That is the overwhelmingly most important thing that you need to know as far as taking trades. And then next, you have to know how to manage your trades. For example, when you take the trade, if you're very confident that the trade is good and that there'll be follow-through, chances are it will not go very far. So you probably have to scalp more, swing less, and go for a smaller target, maybe 1 times your risk. On the other hand, as is the case most of the time, you look at the chart and say, oh, I don't know, maybe it'll keep going, maybe it'll reverse. Okay, when that's the case, you should go for a reward at least 2 times bigger than your risk. So when you see the market gap up or down on a report, remember, there are institutions who will buy that gap, and there'll be other institutions who will sell that gap. Both, if they see this identical trade 10 times, will be profitable because of their trade management. And it will have nothing to do with the doji bar or the candlestick pattern or any other thing in terms of reversal patterns or continuation patterns on candlesticks. You know, let me give you an example. Here's Nike, daily chart of Nike, and it was in a bear trend, not a strong bear trend. It's a channel. Channels are weak bear trends. Lower highs, lower lows, and then it gapped down big on a news report. I think it was an earnings report. And you look at perfect doji star, a very big bar with a perfect close right in the middle, no body. So candlestick traders get excited. Oh, wow, a doji star in a bear trend, this could be the end of the bear trend. It can, but if you watched Fast Money or any business show on that day, you did not hear any trader saying, oh, wow, big gap down and a doji star. If it goes above that bar, it's a buy. Nobody said that. What they said was, you know, do you think it's cheap enough to buy? Do you think it's overdone? Do you think it's at support? Do you think the support's below and it has room to go on the downside? That's how traders talk about it. So it's not the doji pattern that they're interested in. They're interested in all the bars to the left. I don't have much on the left here, but in actual fact, this is fairly close to the bottom of a trading range, a support area. And very often, when the market has a big gap, it trades down to the support area, and all of a sudden, bulls appear. And you say, wait a minute, why didn't the bulls prevent the gap from happening? Well, if you're a bull and you think it's going to test support, why buy here if you think it's going to reach here? So they just wait until it gets here, and then the bulls start to buy. And the bears, if they think it's going to get to support, they're going to sell aggressively all the way down. Even if there's a gap, they'll sell the open, expecting it to go down a little bit further. They may only scalp, but they're going to sell. And this is what resulted. The bears probably scalped, bought back the shorts, and that lifted the market up here. And the bulls, when it got down to what they thought was support, they started buying, and it lifted it to here. Nobody was talking candlestick patterns. Candlestick patterns are for home traders, you know, people like you and me. And they're part of the setup, but they're not the setup. The setup is the support and the resistance, all the stuff to the left. The signal bar is the doji pattern. But the reality is most institutions are placing bets and they're totally ignoring this bar. They don't care. They just are interested in whether or not the market is down to a support level. And then they place a bet. They take a chance. Here's a common situation where you have a bear breakout where the market flips to always in short. So we have a bear bar, another bear bar, another bear bar, and then a bigger bear bar. So we have a bear bar bigger than the one before and another bear bar and breaking out. We have lower highs, lower lows, right? So at some point traders say, it's a bear channel, it's not just a trading range. And at this point, by the close of this bar, most traders would say, yeah, I think it's always in short. It was pretty good. It was in a bull leg up here, and then a pretty good bull leg here, some buying here, but this strong 4 bear bar spike was enough to make me think that the bears have control and that the market is going lower. When the market's always in short, what do? You got to look to get short. In this particular case, we have an II pattern, a small triangle, and you could short below it, or you can say, I don't know, these bars they're good, and it's enough to make me think we're going lower, but the big picture is that of a weak bear channel, in which case the market will probably bounce, and I should be able to sell higher. But I don't know, maybe it'll accelerate to the downside. So traders can short below this bar, they can short at the market, they can short the close of this bar, right? But we have tails on the bottoms of the bars, so some buying. The bodies are big but not huge, so the bears are not all that strong. A lot of traders will assume that this bear spike will be followed by a pretty good pullback. And here the market rallied for about 10 or 15 bars. And it in fact formed a low four short in a bear channel. We had a push up here, okay, so that sets up a low 1. We had a second push up here, sets up a low 2, did not trigger. Then we had another breakout, a pullback, and a second breakout. So 4 pushes up, that makes it a low 4. You can also argue wedge bear flag, push up here, and then 2, 3, 4. Doesn't matter, sometimes wedges have 4 pushes. In any case, this is probably going to be a bear flag. Traders could short, as I said, the close of the breakout bar. As soon as they decided it was always in short, they could sell there. They could sell below this bear bar. But they're looking for a swing. The market's in a bear trend, and they just decided at this moment that it's in a bear trend. So they're looking for a swing. And where does their stop go? Above the top of the spike. You could put it above the most recent lower high, or above the top of the bear spike. The bear spike began with this bear body. To me, I would probably put it above the top of above the lower high. And once you decide that it's always in short, you keep looking for opportunities to sell until the market becomes always in long. And here we formed a triangle. 3 pushes up. 1, 2, 3. You can call it a triangle. You can call it a tight trading range. You can call it a double top bear flag. It does not matter. But what does matter is it's always in short. It did not become always in long. So the bet is that it's going lower. And you look for reasons to short. And it's better to short below bear bars, but when you have a low 4 setup and always in short market, you can short below a bull bar here. Here we've got a bear bar closing on its low after a little rally. It's a sell. Here we have a couple bear bars, and we have a doji bar here. You can sell below these bear bars, another breakout. Bear bar closing on its low after a pullback to the moving average. It's a short. Bear bar closing on its low, relatively big bar. That's a short. Another big bear bar closing on its low. That's a short. Even though it traded up here, it's still a short. And you trail your stops above the most recent lower high. So every time the market goes to a new low, the stop goes above the most recent lower high. So at this point, it fell below a low. So this stop goes down here. Here we broke to a new low. So the stop would move from here down to above this double top. The point of this slide is whenever you have a breakout and the market converts clearly to always in short in the eyes of traders, you can short for any reason, but if the breakout is not all that strong, you have to rely on a protective stop that is above the top of the bear spike, and that sometimes means you'll have a rally that goes on for more bars and covers more points than what you might normally expect. But that's still okay. You decided it's always in short as long as it stays below the top of the bear spike, and as long as it does not clearly become always in long, it's short. And you can keep shorting and you rely on your protective stop. Here's a weak bull breakout, and because it's a weak breakout, you have to expect that you might get a deep pullback. the market sold off sharply here and became always in short, probably on this bar or this bar, and it immediately reversed up after testing near yesterday's close. Yesterday was a bear channel, big gap up, breakout, and 3 pushes down, 1, 2, 3. So this could simply be an opening reversal, a pullback from the gap up breakout above this bear channel. So we have a bear channel, bull flag, breakout, and then a very deep pullback almost down to yesterday's close. In any case, at this bar, you might think, oh, this is not good for the bears. A strong bull bar, big bar, closed near its high, and then a follow-through bar. And then we have another bull breakout. Its close is above the high of the prior bar. So most traders at this point would say, yeah, I think the bulls are in control, and that the sell-off was just an opening reversal. It's just a sell vacuum test of support in the area of yesterday's close. So at this point, traders are always in long. So that means they're expecting at least a second leg up, and they're going to look to buy pullbacks. They can buy this close, they can buy above the high of the prior bar, they can buy for any reason, but their stop is below the bottom of the bull spike, which would be the bottom of this big bull bar, or possibly the most or the low, right? So some traders will say it goes below the bull bar, others will put it here. It doesn't matter. The further the stop is, the more likely you'll be successful. However, when you have a 3-bar bull spike that looks like this, small tails gapping up, this bar closes above that bar, this bar closes above that bar, this bar closes above this bar, and we have lots of signs of strength that the breakout is strong. Most traders would not want the market to come back below the bottom of the spike. In fact, most traders would not want the market to fall more than a tick or so below the top of the signal bar. So anyway, when you're seeing the market flipped always in long, then you see doji, bull breakout, but a big tail, another bull breakout, but a big tail, more tails. At this point, you're thinking, yeah, this could just be turning into a trading range day. You know, big down, big up, big confusion. Confusion equals trading range. In any case, it's still always in long, so traders are expecting a pullback, but at this point, they're probably thinking the pullback will be deep, and it probably will be trading range type behavior, falling below prior minor higher lows. As long as it stays above the bottom of the spike, though, and as long as it does not clearly become always in short, it's still always in long, so you can buy for any reason. So we have a bear breakout on this bar. We have some follow through here. The bulls will say, yeah, it's okay, but it's not nearly as strong as this. It's still always in long. I'm going to buy the close of this bear bar. I'm going to buy the close of this bear bar. I'm going to buy above its high. And that's what the bulls are thinking. The bears, on the other hand, are thinking, well, we had a very strong bear breakout initially. We have another lower high. So we have a high, lower high, lower high, low, lower low, lower low. So at this point, we're still in a bear trend. We're forming lower highs and lower lows, a pretty broad channel. But in their minds, they're still willing to short. Maybe if it gets above this high or this high, they'll think, maybe a trading range and not a bear trend. But they'll still look to short. So all through here, in fact, all through here, both the bulls and the bears are active, and both you have to assume are profitable. You have to assume that institutions are profitable. And at any given moment, you have institutions buying and you have institutions selling. And both are going to make a profit. When the market is unclear, as it is today, right, traders know, or the institutions know, that whenever it's unclear, the probability is around 50%, maybe even 40%. But in either case, any trade that they take, they know that they need to go for a reward at least twice as big as their risk to have a positive trader's equation, to have the math work out on the trade. So the bulls will buy anywhere through here, and they'll go for a reward twice their risk. The bears will sell anywhere in here. Who knows where their stop is? It may be all the way up here, right? And they'll scale in higher. So, they'll short here, and they'll short here, they'll short here, they'll short here. And, they're managing their trade. The bulls, they're buying, they bought all the way up through here, they buy above here, they buy here, and they buy this bear breakout, and they buy this, right? So the bulls are buying, the bears are selling, but both sides are managing their trades. Probably most are scaling in. If you're a home trader, an individual trader and you saw this always in long, you'd probably buy that close. You might buy this, but you'd look and say, yeah, it's good. It's enough to flip it to always in long, but it's not all that strong, so there probably will be a deep pullback. Had you bought this, you might have scalped out for 20 or 30 ticks, expecting a deeper pullback. Had you bought it and you did not scalp out, and you traded small enough, you would have looked to add on during a pullback. So you may have bought more here. If you bought here your full size position, and so you could not scale in long, and let's say you did not scalp out here, you'd hold long through this pullback and rely on your stop, looking for a second leg up. The market has an obvious second leg up here, but a 2-bar reversal, bear bar near the high of the day, probably at this point you're concluding the day is a trading range day. The follow through on the buying is just not good enough, so it's probably a bull leg in a trading range rather than a bull leg in a trend. So had you bought here, you probably would get out of your final position here, maybe take out half here and go to break even on your stop, and it looks like this came pretty close to testing the stop. So the point of the slide is, when you see the market flip to always in long, you have to be expecting a second leg up. We got the second leg up here. And if it's always in long, you can buy at the market as long as you put your stop in the appropriate location. If the stop is too far, you have to trade smaller so that your actual risk is the same. So don't get upset. The market. This is the day that you have. You have to trade the market that you have, not the one that you want. Sure, you want a strong, much stronger bull breakout. You want the 5 or 6 bars closing way up here. That's not what you have. This is the market that you have. You have a weak bull breakout, but always in long, so we should get a second leg up. And you got it at this point. So whenever the breakout is not all that strong, you have to assume that there'll be a deeper pullback. And that's okay. It's still tradable. And what are the advantages of trading breakouts? The probability is very high, and the reward is very high. Breakouts often lead to trends that have a lot of follow-through. The trend, you can have a bull breakout, and it can just trend up and up and up and up and up for many, many, many bars. So you can have a huge reward. Disadvantage of a breakout: if you have a strong bull breakout that goes up for many points and then starts to channel up, and you enter somewhere in that breakout, your stop goes way below the bottom of the breakout, and that means that the risk can be very big. And if your stop is far away, you have to reduce your position size. And trading breakouts is often very difficult emotionally. Difficult emotionally because the risk is bigger than what you're accustomed to experiencing, and the risk grows as the spike grows. You have to reduce your position size, so you have to change what you normally do. It can be happening very fast. It can be scary. It can be stressful. And you have to change decisions with every tick. Where's your stop? Where's your profit target? You start scaling out. It often feels like there's not enough time to make trade management decisions. What kind of management decisions do you have to make? Whether to enter the trend or not. How far away should the stop be? Should it be all the way at the bottom of a bull spike, or maybe halfway, or below some one big bar within the bull spike and not below the entire spike? Your position size, you have to change that if your risk is bigger. Profit target. Since the trend is strong, you have to do some calculating as to what a reasonable target is. Instead of just going for a scalp, you probably should swing for a target that's much larger than what you typically try to attain. Breakouts are extremely common. Remember, every trend bar is a breakout. In a trend, the market's always trying to reverse. So a reversal is an attempt at a breakout in the opposite direction. So if you have a bear trend and you have a reversal, it's an attempt to break out of the bear channel and into a trend in the opposite direction. However, the markets have inertia, and they tend to continue to do what they've been doing. If they're in trading ranges, 80% of attempts to break out will fail. Once they're in a trend, 80% of reversals will fail, and the reversals just become pullbacks. So if you're in a bear trend and you have a reversal attempt, 80% of the time it'll become a bear flag and the trend will resume. Remember, most trend reversals fail and become pullbacks. So if you have a breakout and it's failing and trying to become a reversal, reversals usually fail, and that reversal usually becomes a pullback, and then the trend resumes. Here's an example of a bear trend, and everything in green is a reversal attempt, and all of these reversal attempts failed and became bear flags, and the trend resumed. And as the reversals are happening, they look strong. For example, look at this one. You have two strong bull bars, failed at the moving average. Here you have a double bottom, it broke out to the downside, and you have a micro double bottom. The market went down here and up, and then down and up, and you have a bull bar closing on its high, a possible wedge bottom. However, it ended up being just two legs up, and there's a gap bar at the moving average, a low above the moving average in a bear trend, and you have a bear signal bar, so that's a good low to short. Two legs up, 1, 2. These reversal attempts, despite the strong bull bars, they failed. Here, trying to become a pullback from this breakout attempt, 2 pushes up, 1, 2, it failed, it sold off. Another reversal attempt, maybe a major trend reversal. We have a bear channel, a trend line break, a moving average break, and now a lower major trend reversal. Here's a second attempt at a lower major trend reversal. Maybe it's a wedge also, 3 pushes down. Good looking bull signal bar, it failed. Tried to make a two-legged pullback, 1, 2, and 2 pushes up, 1, 2, and the market was followed by a bear reversal bar and a low too short, and the trend resumed. Another micro double bottom here, and it became a low too short. 1 push up, 2 pushes up, small double top, it failed. Breakouts are extremely common. In trading ranges, breakouts are climaxes. They race up to the top of the trading range, they race down to the bottom of the trading range, and they fail. In a trading range, the breakouts usually lead to reversals, and then the market has a spike in the opposite direction. So it spikes to the bottom, and then it races to the top, tries to break out, and it reverses again. In trading ranges, you have buy vacuums that suck the price up to the top of the range to test the top, and there's no follow through, there's no second leg. The market then reverses and gets sucked to the bottom of the range in a sell vacuum, and eventually the range breaks out and enters a trend, but that happens only about 20% of the time. 80% of the time, the inertia will continue, the trading range will continue. Above every bar on the chart, there are very smart traders, institutional traders, buying, hoping for a successful breakout. Usually, there are more traders believing the exact opposite and are selling, and therefore most breakouts fail. So if the market goes above the high of the prior bar, most of the time there will be more sellers than buyers up there. If it goes below the low of the prior bar, it's trying to break out below, most of the time there will be more sellers than buyers. Below every bar, there are smart traders selling, hoping for a breakout. Usually there are more traders believing the opposite, and they are buying, and most breakout attempts fail. Since failed breakouts are common, traders must be looking constantly for edges, mathematical advantages. To make money, you have to have an edge. You have to have a mathematical advantage. You need a positive trader's equation. And given that most breakouts fail, you have to take that into consideration when you're looking for trades. Failed breakouts are extremely common, and if a trader believes that buyers will win above the high of the prior bar or below the low of a prior bar, he should buy. If he thinks that sellers will win, he should sell. If he thinks there are more sellers above the high of the current bar, he should sell up there. If he thinks there are more sellers below the low of the current bar, and if he thinks there will be follow-through selling and a trend, then he should sell. If he's not really sure, he should wait. When in doubt, it's always better to wait. Will a breakout be successful or will it reverse? This is the single most important concept in trading, and it's the basis of everything that we do. Every entry, every protective stop, every profit-taking limit order, everything that we do as traders comes down to deciding whether or not a breakout will succeed or fail. Remember, every trend bar is a breakout of something, and every breakout fails sooner or later. For example, every tail on the top of a bar is a failed breakout. If you have a tail on the top of the bar, at one point it was a strong bull trend bar, and that tail means that the market failed in its attempt to break out. If you have a tail at the bottom of a bar, the bar went down and then it went up. So it was a failed attempt to create a bear breakout. When there's a failed breakout, you can either get a reversal or a pullback and then a resumption to a new trend. For example, if you have a bull trend and the breakout fails and it starts to turn down, either the reversal can continue down or it can continue down just a little bit, become a bull flag, in other words a pullback, and the trend resumes. You're constantly deciding whether a breakout will fail and create a reversal, or if it will simply become a pullback and result in follow through in the direction of the trend. And if you can decide that either is more likely, a reversal or continuation, then you have an edge. You have a setup with a favorable trader's equation. After the close of every bar, the most important question a trader asks himself is, will there be more buyers or sellers above the bar? Will there be more buyers or sellers below the bar? Breakouts are important because they can lead to an always-in move. In other words, if you have a downside breakout and it becomes clear that the market will continue down, the market has become always in short. And that's important to know, because then the trend will probably last for many bars, and you should not be scalping. You should be going for a swing trade. The trader's equation in that case is very, very positive, very, very favorable for shorts. Whenever you see a breakout, it's a three-step process. First, there's a breakout, for example, a bull breakout. Then there's a failure, an attempt to make the breakout fail. And then the market will either resume the breakout or it'll lead to a reversal. So you'll either get a reversal or a resumption after the failure. What constitutes a successful breakout? Well, one thing is the trade was profitable. Another thing could be that the trader was satisfied with whatever happened. Okay, what is the breakout? It's a trend bar or a series of trend bars. That's the first step in the three-step process. Eventually, there will be an attempt to make the breakout fail and reverse. So let's say you have a bull trend bar, another bull trend bar, another bull trend bar, and then a bear reversal bar. That is the failure of the breakout. And at that point, the breakout will either reverse or pause, become a bull flag, and then resume. So that failed breakout attempt either leads to a reversal of the breakout and a trend in the opposite direction, or simply a pullback, and then the breakout resumes and becomes a trend. The red boxes are weak breakouts. Remember, every trend bar is a breakout. So here's a breakout attempt, another one, and here's the failure, the big tail, and the market tried to go up. Didn't go very far, and it became a pullback from the breakout. So we broke below this bear flag, probably below yesterday's low. Not a very strong breakout. We got an attempt to reverse. This attempt to reverse failed, and it became simply a pullback in the bear trend. We have a strong bear breakout here, but look what followed. A bar with a very, very big tail. So that is the reversal attempt for this breakout. Here's another breakout. You have two strong bull bars. You have a third bull bar with a big tail, and now we have a reversal attempt. The reversal attempt became a breakout pullback, BP, breakout pullback, a pullback from the breakout. Another strong breakout, another attempt to reverse. The attempt to reverse failed, and it became simply a pullback, a breakout pullback. So you got a breakout and a pullback, a breakout pullback buy setup. Here we have bear bars, so there are attempts to break out, but they're not going very far. Here we have a bull breakout, but it's also very weak, small bars and tails. It did not go very far. Here's another bull breakout, did not go very far. Bear breakout did not go very far. Here's a bear breakout and went down for several bars, enough room for a trade. Here's a bull breakout, also small bars, but there was enough follow through for a profitable trade. Here's an attempt to make the breakout fail, and instead we got a 1 bar bull flag. How do you know whether or not a breakout will succeed or reverse? You have to compare the strength of the breakout with the strength of the reversal attempt. You have to decide, are the bulls or bears stronger? If one side's clearly stronger, it's more likely to control the move that follows. If both the bulls and bears are equally strong, you need more information. And that information comes from the next bar or next several bars. So just patiently wait until you get some clarity. Alright, photographic memory test. Be ready. This is going to be fast. What are the signs of a strong bull breakout? There are many. What are the signs of a weak bull breakout? Again, there's a long list. The signs of a strong bear breakout? Again, many, many, many. Signs of a weak bear breakout? Again, many, many in the list. Here's an example of a strong bull breakout, and here are some of the characteristics that make you conclude that it's strong. First of all, you have large bull trend bars, and you have several in a row. They're closing near the high. They're closing above the high of the prior bar. For example, this bar closed above the high of this bar. This bar closed above the high of that bar. So that is a gap. This bar closed above this high. That's another gap. There's also a low above the high of the bar before this bull bar. So that is a gap. That's a sign of exceptional strength and urgency. You have a bull trend bar, a breakout, and the low of the bar following it stayed above the high of the bar before it. So that's a gap over here. The context also makes sense. We're reversing the low of yesterday. You also have to be looking for measured moves based upon the height of the initial spike. Also notice that there's very little overlap among the bars. Up here, lots of overlap among the bars. So the bear breakout didn't go far, the bull breakout didn't go far. Strong bull breakouts look like this. There's also closes around and above resistance. Bear trend lines, a close above prior swing highs, closes above the moving average. Again, signs of a strong bull breakout. Here's a strong bear breakout that failed. A very big bear trend bar, but the very next bar has a bear body, good for the bears, but it has a huge tail and led to a reversal up. So this was an exhaustive sell climax, and it's an example of a strong bear breakout that failed. Traders might buy above its high. Certainly by the time this bar closed, traders would have decided that the market's always in long, and they would be looking to buy. They'd buy the close here, they'd buy maybe the close here, they'd buy at the low of this bar, and they would have been filled on this bar. They would buy above the high of this bar, they'd buy this close, they'd buy this close, they'd buy below that bar, they'd buy above this bar. Here's an example of a weak bear breakout. It failed. You have a very strong bull trend, and you have a double top, a strong bear reversal bar here, too much buying pressure, too much strength here to go short. But here you have a 2-bar reversal, up bar, equally strong down bar, so you can look at it as a second entry short. So the bears are trying to create a downside breakout, but it's weak. Okay, we only had one strong bear bar, not 2 or 3 in a row. You have another strong bear bar, but no follow through. Also, the bars are actually fairly small compared to the size of the bull bars. And the context is bad. This is a strong bull trend, and there has not been significant selling pressure. No breaks below the moving average, no earlier strong bear spikes, so the context is bad for a reversal. Also, no gaps. This bar is a bear trend bar, but it did not close below the low of the prior bar. This bar did close below the low of the prior bar, so there is a gap, but it immediately reversed on the next bar or two. There's also no close below significant support, no close below the moving average, no close below a prior higher low. If there is a strong bull breakout, you want to buy. There's a module later on that talks about how to trade strong bull breakouts. In general, you need to get long. You need to buy at the market or at the close of bull bars and at the close of bear bars. A bear bar is an attempt to make the breakout fail. 80% chance that attempt will fail. So you can buy the close of any strong bear bar. You can buy below the low of the prior bar, assuming the reversal attempt will fail. You can buy above the high of the prior bar, viewing the prior bar as the end of a pullback. You can buy the breakout of any kind of a bull flag. If there's a small bear channel, it's a bull flag. You buy the breakout of that bear flag. That breakout of the bull flag, the bear channel. Remember, every bear channel is a bull flag. So how do you buy a pullback in a bull trend? If the bull flag appears ready to break out to the upside, you place a buy stop at one tick above the high of the prior bar, so that if the market goes above the high of the prior bar, you get stopped into a long position, so you're swept into the trade by the momentum of the trend resuming, which is a great way to enter a trend. So remember, if you have a breakout pullback in a new bull trend, the bears will soon attempt to make the breakout fail and reverse back down, and that's what generates the pullback. If they're unable to reverse the breakout, the rally soon resumes, and that reversal attempt becomes just a pullback in the bull trend, a bull flag. If there's a strong bear breakout, you have to sell, and you have to sell early. Once you think that there's a strong bear breakout, you've got to get short. You can sell at the market. You can wait for the close of a bull bar or a bear bar. If you have the close of a bear bar, you're selling on strength. If you have a bull bar occurring in a strong bear trend, you have to assume 80% chance it's going to be a failed reversal attempt, so you can just sell the close of that bull bar. You can sell above the high of any bar, because that would be an attempt to make the strong breakout fail, and 80% chance that will not succeed. If you get a pullback, you can sell below the low of that bar, because that pullback becomes a small bear flag. If you have a bigger bear flag, you can sell on a breakout of the bear flag, because it's a high probability short entry, expecting the trend to continue down. So if you have a pullback and a bear trend, you got a bear trend and a pullback, you look to short on a stop. You place a stop order, a sell stop order, at one tick below the low of the prior bar. As soon as you see a bear flag that you think that might be ready to break out to the downside, you place that stop order, hoping to get swept into the trend as it resumes down. What about a pullback in a breakout in a new bull trend? Eventually the bears will try to make the breakout fail and reverse back down. They probably will be unable to reverse the trend, and the rally will resume, and their reversal attempt will become simply a pullback in the bull trend. In other words, a bull flag. All bull flags are reversal attempts by the bears, and you have to assume that the bears will fail and the trend will resume. If you have a new bear trend breaking out, at some point the bulls will attempt to make the breakout fail and reverse back up. 80% chance they will not be successful. They should be unable to reverse the breakout, and then the sell-off will resume. Their reversal attempt will become simply a pullback in the bear trend, and therefore a bear flag. So here we have a bull trend. and many attempts to make it reverse. Here's an attempt to make it reverse, a possible final flag, and the reversal attempt simply led to a 5-bar bear microchannel. It held above the moving average, and therefore was a bull flag. Here we got a strong bull reversal. The market probably went always in long in the eyes of most traders over here, so they'd be looking to buy. They'd be looking to buy at the low of the prior bar and above the high of any pullback bar, so they'd buy here. Small pullback, traders will buy above it. A two-legged pullback, traders will buy above this. So here we have a high 2 bull flag. We have a breakout from it, and we have a pullback. Traders will buy this pullback. We have another breakout. Traders will place buy stops above the high of the prior bar and buy there. Another attempt to reverse, possible final flag, not a strong reversal. Traders will buy above the high of the attempt to reverse. A little wedge bull flag, a little pennant. They'll place a buy stop 1 tick above the high of the prior bar and get long again. Here's a better looking attempt by the bears to create a reversal, but the channel up is still very tight, not much prior bear strength. This will probably fail. We had a push down here, the bears had a second push down here, and a third push down here. You can call it a triangle or a wedge, doesn't matter. It's a bull flag and a buy setup, especially when you have a bull signal bar here at the moving average. Each of these arrows are strong buy signals. You place a buy stop 1 tick above the high of the signal bar, and then you enter on the following bar. Here's a bear trend, and lots of attempts to make the trend fail. We are down for 6 bars and tried to reverse. Instead, it failed. Here the bear is becoming more convincing, probably always in short. We had a gap up, and it looks like it's failing. Traders will look to sell. Here's a pullback. They'll place a sell stop 1 tick below its low. Here we have 2 pushes up, a push up here, and then down, push up here. So you get a low 2 short at the moving average. Traders will place a sell stop at 1 tick below the low of that bar, and they'll get filled here for a scalp. Here we're trying to reverse up. Maybe we're getting a double bottom with the low of the day. We have 3 strong bull bars. So it's possible traders will view this as a new bull. They'll try to buy above the high of the bar, buy above the high of the bar, buy above the high of the bar. Here, maybe we're pulling back from this attempt to rally. They might buy above the high of this bar as well. 2 legs down, 1, and then a bull bar, and then 2. But it failed. Here, clearly a bear trend. We're breaking out below the prior low, and we have a series of bear bars. We have a bear micro channel, and traders will expect the bull breakout of the bear micro channel in the bear trend to fail, so they'll look to short below the low of the prior bar. Here's a pullback. They'll place a sell stop at 1 tick below its low and get filled there. Spikes, which are breakouts, are common. We have bear spikes in red and bull spikes in green. So breakouts can succeed or fail. Here's a bear trend. We had several bear breakouts along the way. And here's a very strong bear trend bar occurring 20 or 30 bars into the trend. However, look what followed. A trading range and then a reversal. So a very strong trend bar at the end of a long trend can be an exhaustive end of the trend. Ultimately, actually, this is effectively an exhaustion gap. I'll talk more about that later. We gapped up, and now we're starting to break out to the upside, and now we have a very strong bull trend bar occurring after the trend has gone on for 30 or 40, 50 bars. And in this case, it led to another leg up in the form of a channel. So we had a spike up and a channel. So a big bar late in a trend can be an exhaustive end of the trend, or it can lead to a new leg up. Okay, here's a breakout, and the breakout is strong. We have a strong bear bar here, a big bear bar, small tail, another bear bar, follow through, another bear bar, and not all that much overlap among the bars. And there's immediate follow through, and it's also a logical location for a breakout. A trading range for the first hour or so of the day, and now we're getting a breakout. Maybe the range will double. On the other hand, compare what took place over here with these big bear breakouts bars and the signs of strength on the part of the bears. Compare that to what's taking place over here. Okay, we have bull bars. We're trying to get bull breakouts, but there's no follow-through. Right after the bull bar, you get a doji bar or a bear bar, so you get bars in the opposite direction. The market's largely going sideways. It's also a logical area for failure. We had a very, very strong bear trend. The reversal up is not all that impressive. It's not a series of very strong bull bars. Probably this is all simply a pullback in this very large bear trend. So logically, it's more likely that this is going to be a pullback that would lead to a resumption of the trend rather than a sharp reversal up. So the context is bad for a breakout. Trend bars are many things. Every trend bar and every series of trend bars is a breakout of something. And I often refer to strong breakouts as spikes. But every trend bar and series of trend bars is also a gap, whether or not it is easily apparent. Every trend bar is also a climax. A bull trend bar is a buy climax. A bear trend bar is a sell climax. So every trend bar and every series of trend bars is a breakout, a climax, a spike, and a gap. And it functions as one of those things, one of those four things, depending on context. Here we have a breakout, so the trend bar is a breakout. Here we have a series of trend bars functioning as a spike. Here we have a big bear trend bar trying to break out below the prior low, but it ended up as an exhaustion gap. The low of this bar, the high of this bar, there's space between, so this bar is a gap. However, it marked the end of a bear trend. Here we have a buy climax, a very strong bull trend bar. It could be the start of a new breakout. Instead, it was a failed breakout attempt at the top of a trading range, and it became a buy climax and an exhaustion gap. Here's a gap, the high of this bar, low of that bar. There's space in between, so this bar is a gap. It might have been a measuring gap leading to a measured move up. Instead, it filled over the next few bars, and the market turned down from the top of a developing trading range, and it became an exhaustion gap. Here we have another trend bar, and there's a gap. The high of the bar after it is below the low of the bar before it, and it's at the start of a trend. It might be a measuring gap. And in fact, so if you take the start of the move right here, and you put a measurement in the middle of the gap, it projects down here, and the trend reversed just below this measured move from this measuring gap. So that is a trend bar functioning as a gap. Here's the S&P, or the E-mini chart on the right, the futures contract, and it gapped down. So there's a big gap here. However, this is the cash index. Same chart, and instead of a gap, there's a trend bar. So you should think of every trend bar as a gap, and every gap as a trend bar. Here's a more obvious example. Here's the FAS, which is an ETF based on the financial stocks. And here's the RKH, which is a similar financial ETF, but much less volume. So there are lots of gaps on the chart. Compare the two. The two charts look identical, except that here we have gaps, and here we have a trend bar. Here we have a couple trend bars. Here we have a gap. All right? This gap turned into a measuring gap. The start of the move to the middle of the gap led to a measured move up. These two trend bars created a measuring gap. Even though they're trend bars, they're a measuring gap, and leads to a similar move up. So I think of every trend bar as a gap, and if you look at a comparable chart with thin enough volume, it'll actually appear as a gap. I also think of every gap as a trend bar. If you look at another chart of a similar market, but with much bigger volume, instead of a gap, you'll see a trend bar. Another example, bar 4 is a bear trend bar. Over here, bar 4, there was a gap down. Here we have a big bull spike up on the way to 5, many gaps. Over here it's a series of trend bars. So in my mind, it's interchangeable, gaps and trend bars. Every time I see a trend bar, I assume it's a gap. So what are the types of gaps? On a daily chart, we have actual gaps that you can see. At the start of a move, there's a breakout gap. Halfway into the move, you'll get a gap that often leads to a measured move, so it's a measuring gap. At the end of a move, you'll often, for example, in a bull trend, get a gap up, and then the trend reverses down. That's an exhaustion gap. As if you have a bear trend, every now and then it'll gap, and then gap again and gap again. Those are just common types of gaps. And then there's another type of gap that I call a micro gap. I'll talk about that soon. When the market's having a bull breakout, there'll be a trend bar, and it probably will close above the high of the prior bar. If the next bar has a low above the prior bar before the breakout bar, there's a gap between those two prices, and that often becomes a small measuring gap, and that gap, since it's at the start of a bull move, is a breakout gap. If there's a new bear breakout and you have a bear trend bar that closes below the low of the prior bar, and then the bar following has a high that is also below the low of the bar before the bear breakout bar, that is a small gap, and it's a breakout gap, and it often becomes a small measuring gap. Here's an example. We have a bull breakout, possible bull flag, a bear channel, bull flag, and the close of this bar is above the high of the prior bar, so there's a gap, and the low of the bar after the bull trend bar is above the high of the bar before it, so there's a gap between this low and this high, and that's a possible breakout gap leading to a bull trend. On the other hand, here we have a bear bar closed below the low of the prior bar. We have a second bear bar closing below the low of the prior bar, and then this bar is an attempt to reverse, but its high is below the low of the bar before the bear spike began, and that is a gap, and this could be a breakout gap leading to a bear trend, which it ultimately became. So what is a bull measuring gap? Let's say you have a bull trend bar forming after a trend has gone on, a bull trend has gone on for a long time, 10, 20, 30 bars. And you look at that bull trend bar and you notice that the high of the bar before it is below the low of the bar after it. So there's a little gap. That gap, that bull trend bar is the gap. And that gap might lead to a big measured move. It might become the middle of a very big bull trend. A bear measuring gap, if you have a bear trend that's going on for a long time, and now you have a bear trend bar, and the low of the bar before it is above the high of the bar after it, that bear trend bar is a gap, and that gap might end up being a measuring gap. It might be the middle of the bear trend, so the market might have a lot further to go. So here's an example. When you have a bear trend that's been going on for 20, 30 bars, and then you have a bear trend bar, so a new breakout, and look at the low of the bar before it and the high of the bar after it. This red rectangle is a gap between those two prices. This trend bar then becomes a gap, and it might end up becoming a measuring gap. So you look at the start of the trend up here, you look at the middle of the gap, and you project down the same number of ticks, and it takes you here. And that's in the area where the trend ended. So traders will look to take profits down here. Aggressive traders will look for some kind of reversal pattern. What about an exhaustion gap in a bull? So let's say you have a bull trend that's going on for 10 or more bars, and it's at a resistance level where the context is good for a big pullback. And you suddenly get a bull trend bar, a big bull trend bar closing near its high, right up to that resistance level. And then within a bar or two, it fails and reverses down. That big bull trend bar can be an exhaustion gap. A bear exhaustion gap, you have a bear trend and it's getting close to support, and then you suddenly have a very big bear trend bar closing near its low, right near support. It reverses up in the next bar or two. That big bear trend bar is a sell climax and an exhaustion gap. So here's an example. We have a bear trend that's going on for a long time. And now we have another bear trend bar closing on its low, and its close is below the low of the bar before it. We're at support, right? We're at a measured move target, and now we have a renewed breakout. Traders will wonder if this breakout attempt will become an exhaustion gap. In other words, they're wondering if the next bar will get above the high of the bar before it, closing the gap, which is what took place. We're also at the support of a trend line. So we're at a trend line, in this case a trend channel line, because it's below a bear trend, and we're at a measured move target, and we have a possible final flag after an exhaustive sell climax with consecutive sell climaxes. Sell climax, sell climax, sell climax. Remember, every trend bar is a climax. Sell climax, sell climax, again, again. Once you have a series of consecutive sell climaxes, you have to start looking for a possible end of the trend and a reversal up. Common gaps. Every trend bar is a gap, and trends have lots of trend bars and therefore lots of common gaps, and they have no particular predictive value. They're especially common in trading ranges. You have lots of trend bars that just don't lead to anything. Again, every trend bar is a gap. There's more chance of follow through if the low of the bar after it is above the high of the bar before it. There's a sense of urgency here, so it's more likely that we'll get follow through. However, when the market's in a trading range, you get gaps down, trend bars down, you have trend bars up, and they're meaningless. Most fail and just result in churning sideways price action. And what is a micro gap? For every trend bar, look at the bar before and the bar after. If they do not overlap, the odds of follow through are greater. I gave several examples of micro gaps earlier. So here's an example. We have a bear trend bar. You look at the low of the bar before it as resistance, and if the bars after do not go above the low of that bar, this is a micro gap, and it increases the chances that there'll be more follow through. Here's a bull breakout, and here's a pullback, but the pullback stayed above the high of the bars before it, so there's more chance of follow through. Here's a bear breakout, the low of the bars before it, the highs of the bar after it, a huge gap, probable follow through. Another gap here, a bear trend bar, the high of the bar after is below the low of the bar before, so a micro gap increases the chances of follow through. Same here, same here. So a micro gap is a sign of strength if the gap stays open. If a micro gap closes, follow through becomes less likely. So for example, we have a gap down here, a trend bar here, a low and a high. There's a gap in here, but it closed on the next bar, so chances are not much follow through. Here's an attempt at a micro gap, the low of the bar before, the high of the bar after. There's a gap in between, it closed, and the trend afterwards was not all that strong. And all of these red lines are examples of micro gaps that closed and not much follow through strength. Here's a bear micro gap, right? And it closed and it led to a reversal. So if a micro gap stays open, it's a sign of strength. What about consecutive climaxes? I mentioned that a moment ago. Every trend bar, every series of trend bars is a climax. If you start to get a series of consecutive climaxes without a pullback, you should soon expect TBTL, 10 bars and 2 legs. It's not always exactly a 10 bar correction, but at a minimum there should be 2 legs. It might be 3 or 4 legs. It might be a reversal. and that pullback should have at least 10 bars. So anytime you have a series of climaxes, you have to start looking for a correction, and the correction probably will have at least 10 bars and at least 2 legs. Here's that chart that I showed earlier. Each one of these red boxes is a sell climax, a trend bar, or a series of trend bars, and you have to start thinking that, wow, this is going too far too fast without a correction. So once a correction begins, you have to start thinking, well, the correction probably will be bigger than what people expect. It should have at least 2 legs and have at least 10 bars. This is a parabolic move. You connect the lows here, you have that slope, and then you connect the new lows, and the slope is getting steeper and steeper still, and it's after a series of consecutive sell climaxes. Possible final flag, since it's a low 2 occurring late in a trend, that often leads to a final flag. Here's a final flag buy setup, a 2-bar reversal. This could be the start of at least 2 legs up and 10 bars up. And this is what followed, actually a very strong reversal up. Minimum target is 10 bars, 2 legs. Here we have 2 legs. We have 1 leg up here, pull back, second leg. Here we kept going up. So the minimum was 2 legs and 10 bars, and we got much more than the minimum after a series of consecutive sell climaxes. What is a climax? It's a late, strong breakout, late in a trend, after 30 or more bars. If you suddenly get, for example, let's talk about a bull climax. If you have a bull trend going on for 30, 40, 50 bars, and then you suddenly get the best 2 looking bull trend bars in the entire trend, you have to think that it will attract a lot of profit takers. So the bulls who bought earlier will see this as a windfall, a wonderful opportunity to take profits at a great surprise price. The bears will also see it as probably a brief opportunity to sell at an exceptionally high price. So you might have both the bulls and bears selling, and that could be the end of the trend. So for example, you have a bull trend that's been going on for about 40 bars, and now you suddenly have a strong bull breakout. And it's the best looking bull trend bar, or the best looking 2 or even 3 bull trend bars of the entire trend. It could be a climactic end to the bull trend, especially if the bull trends or trend bars are very strong, closing on their high. The bulls have a lot of open profit, and they're looking for a reason to exit. And they see this as a gift, a surprisingly big final profit. And they would not be taking profits if they were expecting just a little pullback, right? They held on for 20, 30, 40 bars. If they think this correction is only going to be 2 or 3 bars long, they'd continue to hold. They're only taking profits because they're expecting a big pullback, at least 10 bars, at least 2 legs. And the bears know that, and because of that, the bears will start to short aggressively, knowing that they'll probably get at least 2 legs down and at least 10 bars down. So when you see these late breakouts, these very strong breakouts late in a bull trend, traders will be thinking of a possible climax. The bulls will take profits, and they'll not look to buy again until much lower. So there'll be an absence of buyers, for far below on the chart, and the market will get sucked down to some support level. And the bears will see this as a great opportunity to short at a very high price, expecting that there will not be buyers until the market gets much lower. Here's an example, very strong bull trend, and the trend's trying to resume, and we have the best looking bull bar of the entire trend occurring 30 or 40 bars into the trend. It might lead to a breakout and a resumption, but a lot of traders will wonder if it's an exhaustive end of the trend. So a lot of bulls will start taking profits on the close of this bar all through here. Bears will wonder if it's the end of the trend as well, and they'll start to short, and expecting at least 10 bars and 2 legs down. So we got 1 leg down here, maybe a second leg here. Doesn't look like a deep enough correction. So I think the bulls will want it to go down lower before they'll buy again, and we ended up selling off pretty consistently for about 20 or 30 bars. And you can also look at this as a possible higher high major trend reversal. We have a bull trend, a trading range. It broke the trend line. It broke below the moving average. And we have a resumption of the trend and a second attempt to reverse the trend. So this big bull trend bar late in the trend ended up being an exhaustive buy climax. It became an exhaustion gap once bars closed below the low of the bar before the trend bar, and it was also a higher high major trend reversal. Here's a second entry short. Here's a bear trend, series of bear sell climaxes, each of these red boxes, and then look here, the best looking bear bar of the entire trend. Traders will start to wonder if this might be an exhaustive end to the trend. So they might sell that bar, they might sell this bar as well. Incidentally, by the way, when I have these big bear spikes, if I'm looking to fade the move, I'll usually place my stop at a measured move down from the bear spike. So I measure from here to here, and then put a protective stop that many ticks down. And a lot of times I'll scale in just above my stop level. And bulls obviously would be taking profits, and they will not be eager the bears will be taking profits, and they will not be eager to sell again until much higher. They're not going to take profits here and then sell again right here. If they sat through this much of a trend, they're not going to be selling. They're not going to buy back their shorts and then sell again right here, or maybe even right here. They're going to wait for a lot of bars and a lot of points before they're willing to sell again. And that's why, after a series of consecutive sell climaxes without much of a correction during the sell-off, leads to a very big rally. Here we have a series of consecutive buy climaxes, these red boxes. And then now we have two great-looking bull bars closing on their highs. You can say, wow, it's going to break out into a stronger trend. On the other hand, more likely it's going to be an exhaustion move, a climactic end to the bull trend. And bulls will use this as a great opportunity to take profits on their take profits on their longs, and they won't want to buy again until the market goes down for at least 10 bars and 2 legs. Bears, on the other hand, will sell this close, expecting it to be the end of the move, and they'll look for a move down to at least the bottom of the spike, and there usually will be buyers there. The bears will buy back their shorts, so a lot of times you'll get a bounce there at the bottom, right below the bottom of the spike. This is also a higher high major trend reversal. We have a bull trend, a trend line break. I don't have the trend line drawn, but it broke the trend line. It tested the moving average, and it broke again to the upside and had a bear reversal bar. There's nobody left to buy here. The bulls are selling to take profits, and the bears are selling. Here's an example in a bear trend. Consecutive bear climaxes. Each trend bar, each series of bear trend bars is a climax. We have a two-legged pullback, and then we have a strong bear breakout, the biggest bear bar of the entire trend. That is a red flag to traders. Bears will see it as a great gift, an opportunity to take profit on their shorts at a great price. Bulls will see it as a great opportunity to buy for a scalp. They'll assume the bears will buy back their shorts and not look to sell again for many, many bars. So it's a great buying opportunity. That is the end of the module on breakouts and gaps. This is Al Brooks, and this is my price action trading course. This module has to do with trend types. So how do we trade trends? I have a series of modules later on that goes into detail about that. The strongest types of trends, they provide the best opportunity for a big profit. However, they're often scary for beginners because a lot of times there are very big bars. Big bars mean fast market and not enough time to make decisions, and they also mean the stop is further away, so the risk is bigger. beginners are always wanting a smaller stop than what is required in a strong trend. They're waiting for a pullback, and the pullback doesn't come for 1 bar, 2 bars, 5 bars, 10 bars, and the trend just keeps going on and on and on. And before beginners realize it, that they've missed most of the trend and most of the profit, because they were so determined to wait for a pullback where they could use a tighter stop. Once there finally is a pullback, the setup is usually less clear. It's more uncertain, and the pullback begins to look like a reversal to a beginner. And the pullbacks are small and not convincing. It doesn't look like the trend will resume, but it does. The signal bars are often weak in a pullback and a strong trend, so the beginners choose not to take the pullback trade, so they miss the pullback entry as well, and they continue to wait as the trend continues onward. And then the beginners finally decide they're ready to take the trade, and they're thinking, okay, I missed the breakout, I missed a lot of the channel, this is going on too far too fast, it can't go on forever, it's got to go the other direction pretty soon, it's got to be way overdone, this has got to be a climax. So they bet on a regression to the mean, that the trend has gone far enough. So why not try to pick reversals, since the risk is small? If you have a bull trend and a bear reversal bar, you short below, you put your stop above, and you're only risking the height of 1 bar. Sounds like a great way to trade. What they forget, or what they don't realize, is that trends have inertia, and 80% of reversal attempts will fail. And they don't realize how low the probability is for their reversal trade. So they end up losing money on a huge trend day, a day when they should have made a lot of money, because they started taking reversal trades that have very little probability of success, reward probably no bigger than the risk, and therefore a terrible trader's equation. Trends offer a great opportunity to make profit, but you have to understand how they operate, and one good way to understand is to classify them into different types based upon how they behave. All trends begin with a spike. You can call it a trend bar, you can call it a series of trend bars, you can call it a breakout, you can call it a strong trend. I usually refer to it as a spike. Eventually the trend starts to have pullbacks and it enters a channel. As time goes on, the channel gets flatter and broader and it evolves into a trading range. The momentum in the opposite direction increases, and you can start taking trades in both directions. And if the trading range goes on long enough, traders are uncertain whether the direction of the breakout will be up or down. And eventually you get that breakout, up or down, and then the market cycle begins all over again with a new spike, then a new channel, and then a new trading range. All trends contain both a spike and a channel. The spike is the breakout. The two words mean exactly the same thing. And it also is, to me, it's also a strong trend. And you can see the module on breakouts and also the modules on trading breakouts. A channel is a weaker phase of the trend, and there's some two-sided trading going on. There are some pullbacks. For example, if you have a bull trend, you'll occasionally have pullbacks, and during the pullbacks the bears will be in control at least for a bar or two. Most strong trends begin with big breakouts, like a gap on the open and then 1 or 2 more big trend bars. Or there can be a series of consecutive big trend bars. What constitutes a strong trend bar? A bar with a big body and small tails. So, for example, a big bear trend bar closing on its low tick with no tail on the bottom. Here's an example. Spikes can be very, very big. Here's a 2-bar spike, but it's also a continuation of the gap up. So the actual spike is the gap plus these 2 bars. And then we have another spike here, another spike here, another spike here. This channel, it's actually in a channel at this point because we're getting some overlap, some little pullbacks. but the channel is so strong that you know it has to be a spike on a higher time frame chart. This is a 5-minute chart, and if you look at a 15-minute chart, you will not see a spike and channel. You'll just see one spike composed of a series of bull trend bars. Within the channel, there are smaller spikes and then other channels. Here, 2 bull trend bars, both large, closing near their highs. That's a sign of a strong trend. Look at this trading range, a quiet trading range for all of the day, and then at 9:30 there was a report, an FOMC report, and look at this bar, a huge bar, rallying almost 1% in just a matter of minutes. It's about 10 times bigger than the prior bars. That's a very significant bull trend bar. Even with the tail on top, it's still a huge bull body. So this is a huge bull breakout. And this is what followed, an unbelievably large trend. The market went up several percent over the course of the next couple of hours. So a huge breakout can be followed by a huge trend. A huge trend can begin with a small spike. If the context is right for a trend, you can have a single unremarkable trend bar leading to the start of the trend. And it can be followed by a channel that can go on for 30 or more bars without much of a pullback. And the channel can accelerate as the trend goes on and then have a strong breakout. So sometimes the channel can accelerate into a parabolic curve. Here's a huge bull spike and a channel, and then we're trying to break out again. So we're getting a bull breakout of a bull channel. Most of the time that fails. Here's the failed breakout bar. So we have the bull breakout, and then we have the bear bar, which is the failed breakout bar. At this point, it looks like we're probably going to form a pullback, and the trend will probably resume. However, you have to pay attention. You got a bear bar here, and you have a bear bar here, trend bar. Decent sized bars, especially this one closing near its low. You always have to keep the thought in your mind that it's a bear spike. It's possible that this will lead to a bear trend and that this was an exhaustive buy climax. Probably not. The odds are this is probably going to end up being a failed attempt by the bears and a bull flag and another buy. But you have to be open to the possibility that this little bear trend bar, or maybe this little bear trend bar, will be followed by a bear channel that'll go on much longer than what you think is realistic. And that's what actually happened here. So we had a bear spike here, another bear spike here, and a big channel. Another bear spike, and then a wedge-shaped channel down here. Another bear spike and a wedge channel here. So you have a spike down here and a channel, a spike down here and a channel, spike down here and a channel, spike down here and a channel. It doesn't have to be textbook. You don't have to have a spike and then a perfect channel right away. You can have several spikes. You can have channels that can be drawn different ways. I could have drawn this as a micro channel. Instead, I drew it as a wedge channel. I could have started the channel with this bar instead of up here. I could have drawn it very tight just over these bars as a micro channel. The point is, anytime you see a bear spike and the context is supportive of a possible bear trend, here an exhaustive buy climax, you have to be aware of that possibility and be ready to take shorts if a trend follows. Here's another way to view that same chart. You can refer to this as the spike and then this as the channel. It doesn't matter which bars you use to create the channel. It doesn't matter how you draw the channel. It doesn't matter which spikes you use for the spikes. You just simply have to understand that the market is in a bear trend. It's channeling down, no matter how you draw the channel. There are nested patterns within patterns. Here's a spike and a micro channel, another spike, channel. You just don't want to lose sight of the big picture. The big picture is it's a bear trend. Here's another example, a 2-bar bear spike within a trading range, and it could simply be a cell vacuum test of the bottom of the range. We had that over here, we had it over here, less so over here. This could be simply another version of it. But anytime you see a bear spike, you always have to be thinking that it could be the start of a bear trend, and it could be followed by a channel. And here it was. We have another bear spike and a tight channel. This channel became parabolic. If you draw lines connecting the lows, the lines became increasingly steep. So this is a parabolic sell climax. Usually this leads to a pretty sharp rally. Let's say you have a channel that's extremely tight and you cannot tell if it's a spike or a channel. It doesn't matter. Assume that it's a breakout, a spike, and trade it like a breakout. Even if it's a channel, you still trade it like a spike. If you can't tell whether it's a spike or a channel, assume it's a spike, trade it like a spike. And you can look at the module on trading strong trends. It talks about how to trade breakouts. When a channel is very tight, it's still a weak trend compared to a breakout. Remember, a trend is either weak or strong. A strong trend is a breakout. A weak trend is synonymous with a channel. But sometimes channels can be very vertical and very tight, very small pullbacks, and essentially a spike. And they usually are spikes on higher time frame charts. And when you have a channel that is so strong that it's almost as strong as a breakout, you trade it like a breakout. And you only take trades in the direction of the trend, and you try to swing. Here's an example of a gap and a spike. So here's a bull spike in green, and then a channel. But the channel is very tight, very small pullbacks. You certainly would not be looking to short. You would treat this like a very strong trend, even though technically it's a channel and therefore weak compared to a breakout. The slope is less than that of the breakout, but when it's this strong, it's going to be a spike on a higher time frame chart, and I would treat it like a spike and trade it like a spike. Okay, here's an example, a gap and a spike. So this is the spike is the gap opening plus this bull trend bar. And then we had a channel. But the channel has very small pullbacks, and the channel is very tight. This kind of a channel almost certainly is a spike on a higher time frame chart. Here's the identical chart on the 15 minutes. This pink box is the gap, and then here is the 5-minute channel. Here's the 5-minute channel over here, and this is what it looks like on the 15-minute chart. A very strong bull spike. So when you see a 5-minute channel that is very tight, trade it like a spike, because you know that it's a spike on a higher time frame chart. On the other hand, when a channel is very broad with big swings and it's not very vertical, it's almost flat, it's very much like a trading range that has a slight slope. Trade it like a trading range. Take trades in both directions, and like with all trading ranges, buy low, sell high, and scalp. For trading broad channels, you can see the modules on trading weak channels, and you can also see the modules on trading within trading ranges. Here's an example of a very strong bull spike, but it's followed by a channel that has pretty deep pullbacks. The channel is pretty flat and pretty broad. So it's a broad bull channel or a pretty weak channel. You can take trades in both directions when a channel has swings that are this deep. You should make sure that you buy the pullbacks. It's less important to sell the rallies. Remember, we have a spike, a bull spike, so it's a bull trend. We have a bull channel, higher lows, higher highs. It's a bull trend, so you want to make sure to take the longs. You don't have to take the shorts, but if you're aggressive and good at scalping, you can. So if you have a bull channel, is it weak or strong? Is it very tight and very vertical? Or does it have big swings? Or is it something in between? It doesn't matter. Sometimes it's impossible to tell how weak or how strong it is. When in doubt, remember it's a bull channel, which means it's a bull trend. Only take the trades in the direction of the trend. So in the example that I just showed, only look to buy. So why classify the trends into different types? Because there are different types, and they don't behave the same way. And different trends offer different kinds of opportunities for trading. The one thing they have in common is once you decide that it's a trend, try to swing most of your position. Here are the lists of types of trends as I categorize them. Spike and channel. Every trend that you see has a spike and channel component to it. So you see spike and channel trends every day at some point. A trend from the open, in other words, from the very first bar or very first few bars of the day, the market trends for the rest of the day. That happens about once a week. Trending trading range days, where the market's in a trading range, and then it breaks out, and then it forms another trading range. Sometimes it breaks out again and forms a third or fourth. They're pretty common. And very clear ones occur a couple times a week. Trend resumption day, for example, if the market sold off and then went sideways for 4 hours and then sold off again, that's trend resumption. You get those, I have it down here, once a month. The textbook perfect ones are about once a month, but different versions of it are more common than that. And then broad channel trends, including broad wedges and stair patterns. In some form they occur maybe once a week. And then a small pullback trend, where the trend is trending all day long and the pullbacks are tiny. The move is not going up very fast or going down in a bear trend, but the pullbacks are very, very small. This is the strongest type of trend, and you get it about once a month. Every type of trend usually can be classified as another type as well, but usually one type of behavior is dominant. For example, every type of trend has at least one spike and channel in it, but if other characteristics are more prominent, I would classify it as another type and trade it like the other type. Here's a spike and channel bull. The red box is the spike, and the spike subdivided into a couple of smaller spikes. And then we had a channel, and there was a small channel in here and a bigger channel. Big picture, the red box, spike, blue channel, and the blue channel with other patterns within. But this is a typical spike and channel day. A strong bull spike and then a channel for the rest of the day. Trends tend to trap traders. Once you think a bull trend is likely, don't get trapped into shorts. Don't keep looking to pick tops, and don't get trapped out of longs. Every time you see a little reversal, don't assume it'll succeed and exit your longs. Once you think there's a bear trend, don't get trapped into longs. Don't be bottom picking, and don't get trapped out of shorts. Every little reversal looks like it's going to be the end of the trend. Don't get out of your swing shorts, because those reversals, 80% of them will simply go for a few bars and become a bear flag. Again, here's that spike and channel trend. Once you decide it's probably a bull trend, don't get trapped out of longs every time you see the market trying to correct. Assume that every one of those corrections will fail and that the market will resume up. And not only don't get trapped out of longs, don't get trapped into shorts. Don't be thinking, this looks like a great top, I'm going to short this. It's still a bull trend until it's clearly not. And to me, there's no evidence anywhere in this channel that the trend is ending. So don't short. All channels evolve into trading ranges. The channel usually eventually reverses, and the market then comes back to test the beginning of the channel, and at that point you're no longer in a trend and no longer in a channel. You are now in a trading range. So for example, this is the monthly E-mini futures contract. We have a strong spike up and then a channel. Anytime you see a channel, a bull channel, you assume it's a bear flag and that it will be followed by a trading range. At some point you'll look at this and say, it's part of a trading range. And the market usually comes back to test the beginning of the channel. It can bounce there and the trend can resume. We can go sideways into a trading range, or the market can reverse. And that's what happened here. Here's the spider, same chart. Spider is the ETF, spike and channel. We came down and we fell strongly through the bottom of the channel. So you have a bull channel evolving into a trading range, and in fact, instead of just a trading range, it turned into a bear trend. Okay, here are a collection of spike and channels. Every blue box is a spike, and followed by a channel. So we have a bull spike and a channel. A channel evolves into a trading range, and look at the chart. Okay, after this bull spike, the market has been in a trading range. So if you only looked at this point, you'd say, wow, it's a bull trend. We have a spike and a bull channel. Yes, but you have to assume that this bull channel will eventually become part of a trading range. At this point, if you don't see the bars to the right, all you see is a bull trend, a spike and channel up. But that channel probably is also the start of a trading range. Once you have the entire chart, you can see that this is part of a trading range. If you ask to draw the trading range on this chart, it's all the way back here to bar 4, right? And it includes that channel. So even though this channel was part of a bull trend, it ended up as part of a trading range. Market came down, tested over here, tested the bottom of the channel. We have a spike down, wedge channel down, and the market rallied and tested the top of the channel. Here we have a channel up where the lines are parallel instead of wedge shaped as they were on the two prior channels. Within every pattern, there are smaller patterns. There are nested patterns. So within this wedge-shaped channel, there are spikes down and channels down. There are smaller spikes up and channels up. And it's just very common to see smaller patterns nested inside of larger patterns. And if you go to higher time frame charts, whatever you're seeing on the chart in front of you is nested inside some even larger pattern. Okay, this is a particular type of spike and channel. If you look at the cash index, you can see the spike down and then a channel. On the S&P futures, you don't have a trend bar here, you have a gap. Remember, every trend bar is a gap, every gap is a trend bar. So this gap is effectively a trend bar and a spike. So this is a gap spike and channel type of trend. It's just a different version of a spike and channel trend. Now, a trend from the open. This is often a strong type of trend. Within the first few bars of the day, sometimes the very first bar of the day, the market forms either the high or low of the opening trend. The market often forms a trend in the first hour or two, and sometimes the high or low of that trend can begin with the very first bar, and sometimes it remains the extreme of the day for the entire day. And it's a sign of urgency. For example, if the first bar is a strong bull trend bar and the market keeps trending up all day, that's a sign of urgency and usually a sign of a very strong bull trend. Sometimes it can become a trading range, but most of the time when you have a trend from the open, it's a reasonably strong trend. Here's an example. Yesterday there was a very strong bull close and we gapped up, but the first bar of today was a big bear reversal bar closing on its low. It's a good swing short for sure, and it turns out that it was the high of the day. First bar of the day often tells what the day will be. Here we have a very big bear trend bar, and it was followed by a very big trend day. This is also, it's a trend from the open, right? The first bar of the day was the high of the day, so it's a trend from the open bear, but it's also an example of a trend resumption bear. We trended down for the first couple of hours, we went sideways for a few hours, and then we had a second trend down. So a leg 1 equals leg 2 move. Here's leg 1, and then sideways, and leg 2 fell for about the same number of points as occurred during leg 1. And within this channel, there's also a spike and channel. All days have spike and channels, all trend days. In fact, all days have spike and channels occurring at some point during the day. Here's an example of a trend from the open bull. the trend began on the third bar of the day. The third bar of the day was the low of the day, but then we had a very strong trend up from there. A bull spike up through here, another spike here, and then a channel. Several different things that you can call spikes that led to the different channels. Another example of a trend from the open bear. Okay, not a good signal bar for the bears. You're within a trading range and you have a bar with a small body and big tails, so the day might be a trading range day. However, it trended down from the very first bar. Traders would probably start shorting somewhere in here, a low 2 short, after trading down for 7 or 8 bars, and then a double top, so another short. Wedge bull flag, 3 pushes up, 1, 2, 3. Second entry, moving average gap bar. The low of this bar is above the moving average, so it's a gap bar in a bear trend, usually a short. 3 bars up, okay to wait for a second entry. Here's a second entry short. Here, a bull spike and 3 pushes. So this could be effectively a 3 push pattern or a wedge pattern, so also a good short. Here, a low 2 short. The market went up and then down, and then another bull body up at the moving average, so it's a short below the low. A bear micro channel after a very strong bear spike. The reversal up will probably fail, so it's okay to short this as a low 1 short. A trend from the open can be one of the very strongest type of trend days. This is also a trend resumption day. There was a bear trend, a trading range, and then a resumption of the bear trend. Okay, low of the day on the very first bar, so a trend from the open bull, very strong spike, pretty weak channel, lots of overlap, small bodies, a lot of tails, and the day ended up as a trading range. So even though it's a trend from the open bull, and the close of the day was above the open of the day, so the daily chart had a bull bar, a bull body. It was basically a trading range day. You get rid of these 2 bull bars, and all the rest of the day was just sideways. Okay, variations. Every pattern has smaller patterns within it, and every pattern is part of a larger pattern. So if you see a pattern on a 5-minute chart, and then you look at a 15-minute chart or a 60-minute chart, you'll see that whatever you're looking at is actually a small part of something that's much larger. The markets are fractally related. They're basically the same patterns on all time frames. Now, what about a trending trading range day? A fairly common type of trend day. The market will form a trading range for the first hour, 2 or 3, and then it breaks out. Usually not a big breakout, usually 1, 2, or 3 bars, and then it enters another trading range. Less often, there'll be a 3rd or 4th breakout and trading range. Here's a good example. The market was mostly sideways for the first hour and a half, and then a 2-bar bear breakout, and then it was sideways for another 4 hours. So this is an example of a trending trading range day. Very common for the market to try to reverse back up into the upper trading range later in the day. In fact, all reversal days, not all, most reversal days come from some kind of trading range, and most reversal days come from trending trading range days. I mentioned trend resumption a couple of times. Very often the market will have a trend in the morning and then sideways for midday. At the end of the day, 2 things can happen. The trend can resume, so you get, for example, in a bear trend, you can have a down move, sideways, and another down move. You can get trend resumption. Alternatively, you can have a trend down, sideways, and then a trend up. You can get a reversal. So if you have a trading range leading to a reversal, the day becomes a reversal day. And most reversal days, as I said, begin as trending trading range days. So whenever you have a trending trading range day, you have to be aware that it could end up as a reversal day. So you have to be ready for a breakout in either direction. either into a resumption of the earlier trend or a reversal of the earlier trend. Here's an example. The market sold off and then went sideways, and traders did not know whether we would get a resumption of the earlier trend and more selling or a reversal. Here's an example of a trending trading range day. The market was in a trading range and then a lower trading range, and the day became a reversal day. The close of the day well above the open, and this sell-off became a tail on the bottom of the bar on the daily chart. Here's an example of a bear trend and then a trading range, and instead of a reversal up, we got a resumption of the bear trend. Broad channel trends, okay, this is another type of trend, and sometimes it's unclear whether the market's in a trading range or in a weak trend. Whenever you're not sure whether the market has begun a channel or whether it's still in a trading range, trade it like a trading range. Buy low, sell high, and scalp. At some point, if it is a broad channel, and it's still within a trading range, you'll start to see trending highs and lows, and the trend will become clear even though the market's still in a trading range. Once you feel that the market has clearly become a trend, it's good to start swinging part of your position even if you're still within the trading range. You can still choose to scalp until the trend becomes strong. Here's an example of a broad channel trend. We have a spike up and big swings up and down. You certainly should try to take the longs because it's a bull trend, right? A bull channel is a bull trend, so you want to be taking the longs. And you could consider shorts if there was a strong enough setup. Selling is optional. Here's the daily spider chart. We have a high, a couple highs here, a higher high, another higher high, another higher high. We have a low, a higher low, a higher low. You can look at this through here and say the market's in a trading range. It is, but you're also getting higher highs and higher lows, so it might also be a bull channel. And in fact, that's what it was doing. So you could swing longs on any of these pullbacks, or you could continue to scalp. If you do buy, you want to be buying near the bottom of the channel. Here's a potential. After you have these three pushes up, you can create a trend channel line and drag it down below and anchor it to this first low, and then look to buy when the market comes back to the neighborhood of that lower line, especially if there's a reversal up. And once it starts to turn up, you put your stop below the most recent higher low. There's a special type of broad channel trend called shrinking stairs. Not too important, but I'll mention it anyway. You get a series of breakouts. So for example, in a bull trend, you'll have a swing up and then a pause, another swing up and another pause, and another breakout, but each breakout is smaller and smaller and smaller. So the market's stair-stepping up, but the stairs are shrinking. It's a sign of loss of momentum. And once it's clear that the market's in a shrinking stairs pattern, you can start fading breakouts, looking for a test of the breakout point. For example, let's say you're in a bear shrinking stairs pattern, and the last breakout reversed up after falling 10 ticks below the breakout point. The next time the market breaks to a new low, place a buy limit order at 7 ticks below the prior low, looking for a bounce up back to the most recent swing low. So here's an example. Each pink box is the size of the breakout. So here's the breakout point, here's the end of the breakout. The market broke below here and it fell down to the bottom of the pink box. So possible shrinking stairs. So traders will look to buy below this next bar, looking for the breakout to be less than the size of this one, and their minimum target would be a pullback back to that low. So enough room for a scalp. This is actually a very, very big move, and there are a lot of points in here, so there's enough room for a couple point scalp up. and you could usually hold for a test all the way up to the moving average. And a small pullback trend day, I mentioned that is the strongest type of trend day. It's often another type of trend day as well. Very often it's a trend from the open trend. There's usually a spike in channel component to it, and there are usually small trading ranges within it, so it's usually often a small, a trending trading range day with several small trading ranges. It usually begins in the first hour or two, and the pullbacks are all pretty small, less than twice the size of an average bar. Usually after 11 o'clock or 11:30, you get a pullback that is 50% to 100% bigger than the prior pullback, and then a resumption in the close. So let's say you had a bear small pullback trend day, and the biggest pullback was 2 points. You'd look for one 50% or 100% bigger toward the end of the day. So instead of 2 points, you look for a 3 or 4 point pullback later in the day, a 3 or 4 point rally, and you look to short that, expecting a resumption into the close, resumption of the bear into the close. Strongest type of trend day, small pullback day. Look how big the pullback is. Very, very tiny, right? Very small pullbacks all day long. And usually there is a pullback later in the day that's 50% or twice as big as the prior pullbacks. Here, that pullback occurred at the very end of the day, so there was no time left to buy it. The setups never look all that good. Look at the signal bars. You know, they just don't look all that good. The pullbacks are too small to allow making any money on shorts, so you should only be buying, and you should be buying all day long. This is what I was talking about in terms of the late pullback being 50% to 100% bigger than the prior pullbacks. Okay, small pullback trend day. Look how tiny the pullbacks are. You know, just a few ticks. Okay, through this point in the day, the biggest pullback was here, 26 ticks. So at some point in the day, I would expect the pullback about 50% bigger, so 39 ticks or more. And if we do get that pullback, I would look to buy it for a new high of the day. Here we had a pullback, 42 ticks, and 3 little pushes down, 1, 2, 3, and a bull reversal bar. To me, that's a reasonable buy for a breakout to a new high of the day into the close of the day. And that's what happened. We had the move up, but at the high of the day, we got a reversal bar, a bull body, but closed below the midpoint, so it's still a reversal bar. And this might be evolving into a trading range. So to me, I would not get greedy. If I did not take profits at the new high, I would get out below the low of this reversal bar, because the market may be evolving into a trading range. Here is a small pullback bull trend day. It's also a spike in channel. So we have a spike and a channel, and it's a strong trend. So you got to be looking to buy. And we have a bigger pullback later in the day. This is the same chart that I just showed. So you try to buy the bigger pullback, looking for a new high of the day. Here's a small pullback bear trend day. Again, the strongest type of day. Look how tiny the pullbacks are. You got a new low, but look how little the market rallies. But look at the sell setups. Here we got a bull bar and a bull bar here, a bull bar here. You know, those are not strong signal bars. Look at here, you got a doji, another doji signal bar. You got a bull bar, right? The setups never look good enough, and that makes a lot of traders not take the shorts. So they get trapped out of a very strong bear trend day. You know, they keep waiting for a bigger pullback that looks like it'll be safer. They keep waiting for great-looking bear reversal bars for signal bars. You're not going to get them. And a small pullback trend day, this is how they typically look. The pullbacks never look like they're big enough to short, and the signal bars never look good enough to short, but you got to take them. And that is the end of my module on the types of trends. This is Al Brooks, and this is my price action trading course. This module has to do with reversals. When the market's in a trend, it's moving mostly in one direction. For example, in a bull, it's moving up, and in a bear, it's moving down. And when the market is in a trend, it's always contained in a channel. A bull trend forms a series of higher highs and higher lows, and it's contained in a rising channel. The bottom of the channel is the bull trend line. A bear trend is a series of lower highs and lower lows, and it's contained within a falling channel, and the top of the channel is the bear trend line. You should always be looking for support and resistance. Although most resistance fails to stop a bull trend, all bull trends end at resistance. And although most support fails to stop a bear trend, all bear trends end at support. So you should be paying attention to support and resistance and watching how the market behaves and seeing if there is a reversal pattern there, if the context is good and the signal bar is good for a trade in the opposite direction. A reversal, simply a change from one trend into an opposite trend, bull into a bear, bear into a bull. First step in all reversals is breaking the trend line, which is a breakout from the channel. So if you have a bear trend, the first step is breaking above the top of the channel, which means breaking above the bear trend line. The next step is a series of lower highs and lower lows. So if you have a bull trend turning into a bear trend, instead of making higher highs and lows, you're now starting to make lower highs and lows. If you have a bear trend making lower lows and lower highs, and it's turning into a bull trend after it breaks the trend line, you want to see higher highs and lows. You want to see the market start to trend up. Some traders only trade trends. They don't want to trade reversals because the probability within trends usually is high, 60% or higher, that the trend will continue. The risk, however, is often greater because you usually have to use a wider stop, and that's the price you pay to get the higher probability. The rewards also will be at least as big as the risk. Whenever the probability is 60%, usually the reward is equal to about the risk. Other traders only want to trade reversals because they see the potential reward as much, much bigger than the risk, and they're willing to accept a lower probability of success to achieve that very big reward. And there's no right or wrong. Both are acceptable ways to trade. Remember, most reversal attempts fail, and ultimately most reversal attempts become trading ranges and not trends in the opposite direction. Even when a successful reversal trade occurs, usually the reversal results in a big trading range instead of a trend in the opposite direction. But the opposite move usually goes far enough to at least make a swing profit. All reversals actually are some type of double top or bottom. A reversal always involves some kind of a test. So if the market is going up and it reverses, there probably was a test in there and some kind of double top if you look hard enough. Most reversals involve some kind of a trading range as well. All bottoms are variants of double bottoms. All tops are variants of double tops. But very often, some other term is better used to describe what is going on. Sometimes the double top or bottom is so distorted that it's hard to see, and it's usually better described by another term, like a final flag reversal. V bottoms and inverted V tops do not exist. Every instance is something else, usually a small final flag or a wedge. So at the extreme, you could say, hey, there's no double top here. Well, in fact, the market had a top here, a pause, and then it went up for 5 more bars, and this was simply a test of this high. So this reversal, even though it does not appear to be a double top, it is a variation of a double top. The market tried to go down here and then exploded one more time to a new high and then went down again. So even though you might call this an inverted V top, to me the market went up and then had one more climactic top. So this is the second top following this top. There's also a larger final flag here, and this was part of the topping process. It was accumulating selling pressure. Here's an example of a V bottom, but actually the market tried to bottom here. We had a bear breakout, and then we had a couple bars with tails, an attempt at a micro double bottom. Even though this bar did not go above the high of this bar, this attempt at the bottom was the first bottom, and then we had a second bottom here. So I would not use the term inverted V bottom. I would say that this is a small final flag reversal. It also dropped below a trend channel line and reversed, so it's a small wedge as well. But my main point is that it's at least two attempts at a bottom. The market tried to bottom here, broke to the downside, and tried to bottom again. So it's a variation of a double bottom. On this chart as well, you can say, well, where's the double top over here? It's a higher high major trend reversal. There's a trend line break over here, and then a new high. Well, it's actually a double top with this high. The market tried to top out here and failed. It had one more push up. So this top is actually a double top with this. All higher high major trend reversals are some variation of a double top. You can also argue that it's a double top with these highs as well, or with even this high, potential final flag. The market it pushed up here, tried to top out, and failed. It had one more push out up, and then it succeeded. Most reversal patterns are trading ranges. For example, major trend reversals usually occur within trading ranges. Major trend reversals are variations of double tops and bottoms, which is a sideways market. Final flags, a flag is a trading range. Other failed breakout patterns and climaxes usually involve trading ranges. Wedges, usually part of a trading range. Double tops, double bottoms, triangles. These are all potential reversal patterns, and they are trading ranges. Head and shoulders patterns, tops and bottoms, they are trading ranges. Rounded tops and bottoms are trading ranges. A climax is usually a failed breakout from a trading range. Every reversal pattern will be discussed in its own module over the next series of modules. And this is the end of this module on the introduction to reversals. This is Al Brooks, and this is my price action trading course. The current module is about major trend reversals. Here are all the reversals that I talk about in the trading course, and right now I'm going to be talking about major trend reversals. Most reversal patterns are trading ranges. For example, double tops, head and shoulders tops and bottoms, rounding tops and bottoms, wedges, final flags, and major trend reversals are usually variations of double tops or double bottoms, where the second top or bottom is not necessarily exactly at the same level as the first, but functionally it's basically a double top or a double bottom pattern. All trend reversals are a change from a trend into an opposite trend. The opposite trend usually goes far enough for a swing trade. Most of the time, a big trading range develops. Sometimes you get a big opposite trend following a major trend reversal. Most of the time, you get a big trading range where the legs are big enough to take swing trades. Here are the steps required for a major trend reversal. First, you need a pullback in the trend that breaks the trend line, which means a breakout of the channel. Next, you want the pullback to test the moving average, preferably to go beyond the moving average. Next, you want the trend to resume. And once the market gets down in a bear trend to the old trend extreme, or once it gets up to the old bull high in a bull trend, you want another pullback to begin, and this pullback then grows into a reversal. Again, most reversals usually become trading ranges. So for example, here's a higher high major trend reversal, a trend line break. I don't have the moving average drawn in here simply to simplify the chart. So we got a trend line break, a higher high major trend reversal. The market trades down, but we ultimately go sideways. Here we have a bear trend, a trend line break, a higher low major trend reversal. The market goes up, but again within a trading range. And then a lower high major trend reversal and a higher low major trend reversal. All the reversals go far enough for a swing trade, but each reversal ended up in a large trading range rather than in a new sustained trend. The major trend reversal does not confirm a new trend. It's the setup that can lead to a new trend. What's required to confirm that a reversal has taken place? If you're talking about a bull trend to a bear trend, you need a bear breakout of the channel and then a series of lower highs and lows. And if you have a bear trend and it's converting into a bull trend, you need a break above the bear channel, and then you need higher lows and highs. And at that point, you have a bull trend. The name major trend reversal, the abbreviation MTR, I'll use this on a lot of the slides. It's not major. So the word major is misleading and implies it's more important than any other type of reversal, and it's not. It's just one in a long list of reversals. And a major trend reversal, it's not even a reversal, at least not yet. It's a setup and not a reversal. It allows traders to enter early before the reversal actually is confirmed. The early entry allows for a minimum risk and a maximum profit. The trade-off is probability. Whenever you're going to get a lot of profit with very little risk, the chance of success is small. So a lot of major trend reversals have probabilities of 40 to 50% and not 50 to 60%. Major trend reversals, they're great setups. It's the single best setup for beginners, and it should be the focus of everyone starting out. And it's also the best setup for experts as well. It has the strongest trader's equation. Again, an excellent trader's equation. The reward is usually at least 2 times greater than the risk, and it occurs often enough so that you can make a living trading it once you get good at it. On any given 5-minute chart, there's usually at least one a day. The advantages of a major trend reversal: first of all, time is on your side. You can usually anticipate the formation of the major trend reversal setup many bars in advance. It gives you a lot of time to evaluate the setup, so it's much less stressful. It's also easier to manage than a lot of trades. There's less thinking. You can rely on a list of simple rules to manage your trades. Nothing is without problems, and there are disadvantages to major trend reversals. And one of the biggest problems is that in return for the big reward compared to the risk, the probability is often only 40%. So 60% of the trades are either small losers or small winners. You cannot have big losers because your stop is not all that big. It's also difficult not to exit early because, for example, if you're starting to get a bull trend, the first pullback or two is sometimes big enough to make you wonder if the bear is resuming, and it's difficult to rely on your stop and hold through that test of your entry price. I mentioned it's easier to manage than most trades. You put your stop, your initial protective stop, beyond your signal bar. So in a reversal up, your signal bar is a bull signal bar, bull reversal bar. Stop goes below. And once you have a reward equal to twice the size of your risk, you take half off, for example, and you move your stop to break even, and then you hold on to the trade until you get a reversal in the opposite direction or until the end of the day. Again, a very good trader's equation, so it's a good trade. The probability 40 to 50% most of the time. It can be higher, but usually 40 to 50%. But the reward is at least 2 times the risk and sometimes greater. When the probability is very high, chances are the reward is going to be smaller or the risk is going to be larger, because whenever you have something that has a very high probability, you cannot have also a high reward compared to risk, because there won't be an institution willing to take the other side of that trade. So whenever something looks very likely to happen, in general, the reward is going to be about the size of the risk and not 2 or 3 times bigger. Okay, probability of only 40%. How can you make money? Let's look at an E-mini trade where you're risking 2 points to make 4 points. A reward 2 times the risk. If you take this trade 10 different times, 40% chance of success, so you have 4 winners at 4 points each, you make 16 points. Let's say you have 6 losers at 2 points each, which is a worst case scenario. You lose 12 points. And at the end of 10 trades, you have a net of 4 points profit. So it's a positive trader's equation. The math is actually much better than that, because you'll exit most losers before you get a 2-point loss. So on the 6 times out of 10 when you don't make 4 points, you will not lose 2. In fact, you won't lose on all 6 of those losing trades. Some of those trades will be break even, some will have small wins. Also, the probability is usually better than 40%, might be 45%, 50%. And sometimes trades will go much further than 4 points. And all of these factors make the result better than the numbers I showed on that prior slide. So how do you trade major trend reversals? I have a series of modules about trading major trend reversals later in the course. After any big change, like a breakout, a climax, or a reversal, a major trend reversal, the minimum likely objective is TBTL, 10 bars, 2 legs in the opposite direction. So if you have a bear trend and then a major trend reversal bottom, you should look for at least 2 legs up and at least 10 bars. If the major trend reversal pattern is much bigger than a typical pattern, you'll probably get much more than 10 bars up, because if it's a big pattern expanding or covering 30, 40, 50 bars, it's probably a major trend reversal on the 15-minute chart, and you'll probably get 10 bars up on the 15-minute chart, which would be 30 bars up on the 5-minute chart. Okay, I said the major trend reversal is a setup and not an actual confirmed reversal. A setup is made of 2 things. Context, it has to make sense that a reversal would be taking place, plus the signal itself, the signal bar. For example, the context, let's talk about a bull trend. You need a break below the trend line, a break out of the bull channel. You need a test of the moving average, not absolute, but usually the sell-off is enough to hit the moving average or go below. And then you need a resumption of the bull trend. And then once the market gets to the area of the prior bull high, you need a strong bear signal bar. So you need context and you need a signal bar. Major trend reversal tops, they're all variations of double tops. Sometimes the second high is a little bit higher and you have a higher high major trend reversal. Sometimes the second high is a little bit lower and you get a lower high major trend reversal. Again, all major trend reversal tops are variations of double tops. The second top may be a little above or a little below the first top, but the basic principle is the same. The market's testing the high of the bull trend and it's deciding whether to break out and resume the bull trend or whether to reverse. A major trend reversal bottom, basically all are variations of double bottoms. Sometimes the second low goes a little bit below and you have a lower low major trend reversal. Other times it doesn't quite get down all the way to the prior bear low and it forms a higher low major trend reversal. All major trend reversal bottoms are simply double bottoms, and the second bottom may be a little bit above or a little bit below the first. It may be exactly the same as the first. The principle is the same as with the double bottom. The market is testing the low of the bear trend and then it's deciding whether it should break out and resume the bear trend or reverse. For example, here's a double top major trend reversal. It's exact to the tick. So we have a bull trend, a break of the trend line, a test of the moving average, did not quite get to the moving average, and then a resumption of the trend, but this resumption is much weaker than the initial trend. And if you looked at some kind of indicator, stochastics, or some kind of oscillator, you would see a divergence here. You don't need the oscillator to be able to tell that this leg is weaker than this leg. So you know there's a divergence. So we have good context, a trend line break, moving average test, a weak rally testing the prior high. However, we do not have a strong signal bar. We have a doji signal bar. You can take that short. It's a reasonable short. When in doubt, it's usually better to wait for a second entry. And here we have II pattern, an inside bar, and then a second inside bar. And that would be a second attempt to reverse the market down. So that would be a higher probability setup. Now, I said this pullback did not quite reach the moving average, and it's true. But it's also an 8-bar long triangle. 3 pushes down. 1, 2, 3. And a triangle after a protracted bull trend often becomes the final flag of the bull trend. So it's a major trend reversal and a final flag reversal. And there was enough selling pressure within this triangle to warrant looking for a short on the test of the prior high. You prefer the sell-off, the break below the trend line to touch the moving average or fall below it as a sign of selling pressure. But here we have 3 pretty good bear bars, and then there was a 4th bear bar here, and we have 2 other bear bars here. So we're accumulating selling pressure. So for a major trend reversal top, it's a reversal from a bull trend to a bear trend. You need to sell off the breaks of the bull trend line. In other words, a breakout below the bottom of the bull channel. You need it to reach around the moving average as a sign of selling pressure. And you can have other ways to demonstrate selling pressure as well. For example, you can have a few very large bear trend bars, or you can have 10 or more weaker bear bars showing that the bears are beginning to exert control over the market. Whenever there's a strong bull trend, you always draw a trend line before there's any sell-off. And it's a reminder that a major trend reversal might follow a break below the trend line. In other words, a bear breakout below the bull channel. After the break below the bull channel, if the bull resumes but reverses down again after testing the bull high, the reversal is a major trend reversal. And again, the test of the old bull high can be a lower high, an exact double top, or a higher high. If the reversal is a higher high or a double top, it's usually followed by a lower high major trend reversal. A moving average gap bar is a bar with a high below the moving average. So if you have a bull trend and then a sell-off below the bottom of the bull channel and below the moving average, and you have a bar with a high below the moving average, that often leads to the final leg of the bull trend. It usually leads to the leg up that tests the old bull high and begins the reversal into a trend down. So here's an example. We have a bull trend. Here's a channel. A strong break below the bottom of the channel and the trend line, and below the moving average. And then we have a second strong bear bar. So we're starting to accumulate selling pressure in here. We have a triangle, 3 pushes down, and then a rally into a new high. So a higher high, and then we have a small bear bar for the signal bar, and the market reversed down. So you sell 1 tick below the low of that bar for a swing trade down. You're looking for at least 10 bars and 2 legs. So we have 10 bars here, but it's only 1 leg. We have a rally and then a second leg down. However, this rally set up a lower high major trend reversal. We have a bull trend. I could redraw this trend line so that it goes over here. Okay? So this would be the break of the trend line, and this would be the lower high major trend reversal. and the sell-off, and then here we have a double top, or you can view it as another lower high. So we're starting to get lower lows and lower highs, and we're starting to convert into a bear trend. Here, by the way, is an example of a moving average gap bar. We have a bull trend, a strong bear breakout through the bottom of the trend and below the moving average, and here we have a bar with a high below the moving average, and here we have a couple more bars with highs below the moving average, and these bars usually lead to the final leg of the bull trend, which it did here. After a lower high major trend reversal, why would you not take profits here? Because after a major trend reversal, you want at least 2 legs down, and this is just 1 leg down. So here, you'd still stay short with a stop above the high of your signal bar, looking for at least 1 more leg down. This is a daily chart of Nike. So these signals work on all markets and all time frames. Here's ExxonMobil with a 5-minute chart with a series of major trend reversals. Strong bull trend, trend line break below the moving average, several good bear bars, lots of selling pressure in here. So you have to wonder if the next leg up will lead to a major trend reversal. The bears tried to reverse here and failed, and they have another strong leg up to this point. When it's that strong, I would not take the first signal. Here's a second signal with a good bear signal bar. That would be a reasonable short. The market reversed up again, and now we have 3 pushes up. 1, 2, 3. This sell-off, a lot of selling pressure again. Broke below the trend line, broke below the moving average. This could be the final leg of the bull trend, especially since it's a 3rd push up. And a potential final flag. A lot of times when you have a small high 2 late in a trend, it becomes the final flag of the trend. So this would be another short. And then we went slightly, I can't tell if this went above this, it looks like it might be a little bit below that. But anyway, it's a second entry short for a higher high major trend reversal. We have, here's a high, here's a higher high, and here's a second entry short. We sold off again, but again found buyers. So we may still be channeling up, forming higher lows and higher highs. And then we have a very sharp rally up here. Not a good signal bar, but this turned out to be an exhaustive buy climax and led to a sell-off. This, I think, is a pretty aggressive sell after those 4 bars up. When these are forming, when you're getting the best-looking bars late in a trend, you always have to be suspicious that it's a climactic end of the trend. Also, the market now is selling off after every new high. Went above here, sold off. Went above here, sold off. Went above here, sold off. So when we go above a prior high, the market will probably sell off because we're transitioning from a bull trend into a trading range. Trading range, buy low, sell high. We're high, better to be selling. For a major trend reversal bottom, it's a reversal from a bear trend to a bull trend. You're looking for a bear trend, and then you're looking for a rally that breaks above the bear trend line. In other words, it breaks above the bear channel. You'd like it to reach around the moving average. The stronger the rally, the more likely you'll get the reversal on the test down. And you want the rally to have buying pressure. For example, it can have a few very big bull bars, or it can have 10 or more weaker bull bars. But you're trying to see some kind of buying pressure in that test up, so that when that market tests down again, the market will probably either be in a trading range, in which case you can buy low, or it could be reversing in a major trend reversal. So whenever there's a strong bear trend, always draw a bear trend line before there is any rally. And it'll serve as a reminder that a major trend reversal might follow a break above the trend line. After the market breaks above the trend line, if the bear resumes again and reverses up after testing the prior bear low, that is a major trend reversal setup. The test is some kind of a double bottom. It can be perfect. It can be a higher low. It could be a lower low. If it's a lower low or a double bottom, it's usually followed by a higher low. That's because a major trend reversal usually has 2 legs up. So if you have a lower low, you want to have 2 legs up, you'll have to then have a higher low to start the second leg up. Again, that bear trend, when it rallies to the moving average, a lot of times it'll go above the moving average, and you'll have a bar with a low above the moving average. In other words, there's a gap below the low of the bar and the moving average. And once you have a gap bar in a bear rally like that, it usually leads to the final leg of the bear trend. So it could be a sign that the next leg down might be the final leg. So you look for a reversal up after the market works its way back down to the area of the bear low. Here's a bull trend. Sideways move that broke below the trend line, and it broke below the moving average. Here's a gap bar, so that's good selling pressure. If the market was able to put a bar completely below the moving average, that means the bears were reasonably strong. A gap bar usually leads to the final leg of the trend, which it did here. So you start looking for shorts. Here we have a small double top. You could short below here, you could short anywhere up in here if you use the appropriate stop. I talk about trading these patterns in a later module, but let's say you shorted here. You'd expect 10 bars, 2 legs down. We got 1 leg down, and the market continued down the following day. Here, a bear trend all the way down to here. This segment of the bear trend had a rally that broke above the trend line. I did not draw a trend channel line below, but this is a bear channel. So we got a break out of the channel, and we now have a gap bar, a bar with a low above the moving average. So there's a gap between the low of the bar and the moving average. That means there's pretty good buying pressure, and it could be the final, it could lead to the final leg of the bear before there's a reversal. And then at the bottom, there's a decent bull reversal bar forming a lower low major trend reversal. Here's a lower low and then a higher low major trend reversal. We get a bear trend, breaks the trend line, no good reversal until we get all the way down here. It's actually a wedge lower low, 3 pushes down, 1, 2, 3, and a decent reversal bar, especially after a potential final flag. Also a wedge bottom using this low, 1, 2, 3. If you use this low, this is a break below the bear trend channel line and a reversal up. So it's a decent lower low major trend reversal. After lower low major trend reversals, the market usually then forms a higher low major trend reversal, which it did here. And it's basically a double bottom with this pullback. So this is a second entry long. Here's an example of a bear trend, a trend line break and a gap bar. So the next leg down might be the final leg of the bear. And we have a lower low major trend reversal here. So you'd expect that after some rally, there would be a pullback and then a second leg up, and that pullback would be a higher low major trend reversal. This is the daily chart of the EWZ, which is a tracking ETF for Brazil. Again, bear trend, so you draw a trend line. We have a break and it hits the moving average, and we have enough buying pressure to keep the market up for about 10 bars. So you think that the next leg down, you may have a major trend reversal. We have a strong sell-off, a sell climax, big bear bars closing on the low, and then we have a bull inside bar, reasonable buy setup for a potential major trend reversal. We have a higher low, not a good signal bar, it's still worth buying, and then we have another higher low, this time with a bull bar. So you place a buy stop 1 tick above its high, did not get filled here, did get filled here, and that's a very good setup for a swing trade, and we broke to the upside. So it was a lower low major trend reversal followed by a higher low, and the higher low had a second higher low. This is a triangle. Anytime you have 3 pushes up or down, it's a triangle. We have a push down here, number 2, number 3, so it's a triangle. Expanding triangles, they're all major trend reversals. Sometimes the legs are not quite as strong as I'd like them to be with traditional major trend reversals. But in general, the second, third, or fourth leg of the triangle always breaks the trend line and comes close to the moving average. And even if it does not, I still treat it like a major trend reversal. So all expanding triangles are variations of major trend reversals. So anytime you see an expanding triangle, treat it like a major trend reversal. So what's an expanding triangle? It's a triangle that gets wider. So here's a push up, another push up, another push up. Here's a push down, another push down. So we have 3 pushes up, so there's a triangle, but the second push down is lower than the first, so it's an expanding triangle. Now we have a bull trend and a trend line break, but the trend line break is only a couple of bars. That's normally not enough selling pressure to look for a higher high major trend reversal. But given that it's an expanding triangle, I think there's enough selling pressure from the first leg down and then the second leg down to go ahead and take the short, especially when you have a perfect 2-bar reversal with the second bar closing on its low tick. So if you're looking at this as a major trend reversal short, I probably would not take it. If I did not see the expanding triangle, I would say not enough selling pressure on this break below the trend line. So if you treat it as simply a higher high major trend reversal, I'd say probably not ideal. I probably would take it because the single bar was so good and we might be transitioning into a trading range. But if I saw that it was an expanding triangle, I definitely would take the trade. This is what I mean by the expanding triangle. 3 pushes up. Obviously the second one went above the trend line connecting the first and third. I could have drawn the trend line across here and it would have gone up here somewhere. It doesn't matter. It's basically an expanding triangle. And that overcomes the lack of selling pressure in this break below the bear trend. Because you had 2 legs down, and even though this is the one that was the breakout below the bear trend, these 2 bars, it's also the second leg down. So we've had pretty decent selling pressure in the first 2 legs down. Here's another expanding triangle. 3 pushes down, so it's an expanding triangle. Now, why is this a higher low major trend reversal? Right? Because we had a bear trend, big gap down, strong bear spike, a big breakout above the moving average, and now we're forming a higher low. And every expanding triangle is a major trend reversal. So we had the earlier expanding triangle up here, so an expanding triangle top for the major trend reversal. And expanding triangle tops are usually followed by expanding triangle bull flags, which is the case. And now we have an expanding triangle bottom, a higher low, major trend reversal. Bear trend, trend line break, and a higher low. There's the trend line, and here's the break above the trend line. Again, all expanding triangles are major trend reversals. Here's a bear trend, a break above the trend line, and then a lower low. You can look at this and say, yep, lower low major trend reversal, adequate signal bar. But you can also look at it as an expanding triangle. 3 pushes down, 1, and then second push, and then third push. And then the first push up was followed by a higher push up, so it's an expanding triangle. Again, I could have drawn the lines across the lows of 3, and it would have put this line down here. It doesn't matter. It's close enough, and in trading, the best you usually get is close enough. This is still 3 pushes down, 2 pushes up, and the pattern is expanding. Expanding triangle, it's always a major trend reversal, so a reasonably good buy. Now, you've heard me say repeatedly that most reversals fail, and the reversal pattern that I tend to pick on the most is the head and shoulders pattern, because that's the one you hear the most on television or in books, that, oh, wow, it's a head and shoulders top or it's a head and shoulders bottom, and therefore the market will reverse. No. If you see a head and shoulders top, it's probably a bull flag. If you see a head and shoulders bottom, it's probably a bear flag. Every now and then, you get a reversal instead of a continuation of the trend. So sometimes, rarely, head and shoulders tops lead to reversals. Head and shoulders bottoms sometimes actually lead to reversals. But most head and shoulders bottoms become bear flags and the market continues down. Most head and shoulders tops become bull flags and the market continues up. Protective stops, I have a module on stops and you can refer to that. The one important rule about stops is no matter what size stop you choose, always make sure that the dollars that you're risking are within your comfort zone. And if they're not, trade much smaller. Immediately cut your position size in half. If you're ever worried about losing money, you'll not follow your rules and you will lose money. So anytime you're worried about losing money, you will lose money because you will not be objective, you'll be emotional, and you're trying to follow what the computers are doing, and they're not using emotion. So you're doing something that the computers are not doing, and you will lose. Okay, if a trade requires a stop that is very large, let's say 3 times bigger than what you usually use, reduce your position size to 1/3 or even 1/4. Trade very, very small. Okay, so if a stop has to be 3 times bigger, your reward has to be 3 to 6 times bigger than normal, and you will end up making the same number of dollars even though you traded very small. Most of the time, major trend reversal signals become small winners or losers. Big winners come less than 50% of the time, but you need that occasional big winner to make major trend reversals worthwhile. So you have to treat them as swing trades to make sure that you capture those big winners. And by a big winner, I mean a reward at least twice as big as the risk. And that you need at least twice as much as you're going to risk to overcome the lower probability. Cardinal rule of all trading: always make sure that for every trade, at a minimum, your profit target is at least as big as your protective stop. Never go for a profit that is less than your protective stop, because if you do the math, you'd have to be right 80 or 90% of the time to make a profit. And very few traders can be that good, day after day, year after year. So don't worry about trading that way. Instead, look for bigger profits. Always want a profit at least as big as your stop, and preferably twice as big as your stop. The initial protective stop is beyond your signal bar. So if you're buying a bull reversal, the stop is below the signal bar. If you're selling a top, the initial protective stop is above the signal bar. If the signal bar is too big and you don't want to risk all the way to beyond the bar, risk to at least beyond the middle of the bar. You can also risk a money stop. So instead of a price action stop based upon the bar, you can risk a fixed number of ticks, like 8 ticks or 10 ticks or 20 ticks or 50 ticks from your original entry price, depending on the individual market. So here's a big signal bar, and traders might be nervous risking all the way to the top of the bar. If they did, they have to trade small, right? If your risk is, let's say, twice as big as normal, you have to trade half size. Alternatively, you can trade your normal size, but put the stop, instead of all the way above the top of the signal bar, maybe just a little bit above the middle of the signal bar. So here's the signal bar. You'd short 1 tick below its low, and you might put a stop just above the midpoint of the bar. Higher chance of being stopped out, but you're risking less, and you'll probably make about the same as trading half size and putting a stop above the top of the signal bar. Okay, an example of protective stops using an expanding triangle. Again, it's a form of a major trend reversal. So this is an expanding triangle bottom that I'll be talking about. And the minimum objective with an expanding triangle is always the opposite side of the triangle. So if you have an expanding triangle bottom, the minimum objective is a test of the top of the triangle. Here's your signal bar. Here's your entry bar. Your initial stop is 1 tick below the low of the signal bar, and you're trying to hold on to a profit target at the high of the triangle. And this is the end of the module on major trend reversals. This is Al Brooks, and this is my price action trading course. The module has to do with final flags. Again, I'm going through the list of common reversal patterns, and this module has to do with final flags and other types of failed breakouts and climaxes. Final flag. After a trend reverses, you can look back and find the last flag in the trend, the final flag. For example, the last bull flag in a bull trend before the market reverses into a bear trend is the final flag. Even small trends, even a small leg in a trading range, can end with a final flag reversal. There can be a small final flag, a breakout, and then a failed breakout and a reversal. So what are the characteristics that a flag has that makes traders wonder if it's the last flag in the trend? If you are aware of those features, then you'll look for the breakout of the flag to fail and for the market to reverse. The final flag in a trend has characteristics like these. The flag is often sideways, like a trading range, often a triangle. Because it's sideways, it has two-sided trading and it has magnetic pull, and that means that the risk of a failed breakout is greater. Remember, most trading range breakouts fail and get pulled back into the range. Final flags are easiest to spot when they come in the form of a trading range late in a trend. So if a trend goes on for 30, 40, 50 bars and then it develops a trading range, that trading range might be the final flag in the trend, and the breakout of that range might fail and lead to a reversal and then a substantial pullback or a substantial correction. A common situation, for example, a final flag in a bull trend. You have a bull trend that's going on for a long time, and then it forms a high 2 buy setup or a triangle just below some resistance level, and that flag often becomes the last flag in the bull trend. So when you see that, when you see a horizontal flag occurring just below resistance late in a trend, you have to be ready for the breakout to fail and for the market to create a reversal down, and it's often a very good short. Final flag in a bear. You have a protracted bear trend that goes on for 30 or more bars, and then it forms a horizontal correction like a low 2 short or a triangle just above a support level, and you have to suspect that the market may plunge down to the support level and then reverse up and start a correction, a large two-legged 10-bar or more correction, enough of a correction for a swing trade on the long side. Again, you're looking for a flag that forms close to support in a bear. So you have a bear trend, a flag right above support. The market breaks to the downside, look for the reversal up. And in a bull trend, a flag that forms right below resistance, the market will often break out of the flag, hit the resistance level, and then reverse down. The breakout from the flag might get vacuumed up to the target, the support or the resistance. The breakout then fails, and the market then reverses. Final flag can be small, or it can be very large. It can be a one bar pullback. You can have a 1-bar final flag. You can have a very big final flag. It can be 50 sideways bars in an extremely tight trading range. It can be a triangle or any other kind of a pullback or trading range. And the reversal itself can be a major trend reversal. So sometimes final flags break the trend line, test the moving average, and then the breakout and reversal create a major trend reversal. You need both context and a signal bar. Context indicates that a reversal is reasonable, and a signal bar has to be strong enough to fit the context, and you manage it like any other trade. The initial stop is beyond the signal bar, and the minimum reward is twice the risk. Here we have two types of support at the same price level. We have a leg 1 equals leg 2 measured move down. We have a sell-off, a trading range, and then a resumption, and the leg down fell exactly the same number of ticks as did the first leg. So it's a perfect measured move, leg 1 equals leg 2, and it's also at the bottom of a trend channel line. So we have two types of support here. So this horizontal trading range might end up being the final flag in the bear trend. And you could also argue that this bear inside bar might be a 1-bar final flag. Here we have a sell climax after an earlier sell climax, and we have a pretty good bull inside bar closing near its high tick. So, and this is also an expanding triangle. We went down, up, and down. So we have several factors making traders believe that this could be the final flag of the bear trend. You know, final flag here, one bar final flag here. Expanding triangle, always treat it like a major trend reversal. There's a bear trend, a trend line break, and a lower low major trend reversal. And then here we have a higher low major trend reversal. So here's that same chart, horizontal trading range. There's a triangle within it and a potential one bar final flag as well. So this could be the final flag, and this as well could be the final flag. Markets often come back to test around the apex of a triangle after a breakout. So here we have a bear breakout, and the market came back to test around the apex of the triangle. There's enough room up there for a swing trade where the profit potential was at least twice as big as the risk. If you buy one tick above the signal bar, your stop is one tick below. The market went up more than twice that amount. Here's a potential final flag in a bull trend leading to a reversal. Now we have a bear trend, a gap down, and more bear trend, and now we have a horizontal trading range late in a bear trend. The bear trend's gone on for about 40 bars or so, and did not quite get to the moving average, but it lasted about 15 bars, and that's enough buying pressure so that the next leg down might fail. And here we have a bull reversal bar. So this became the final flag. Here's a buy signal. Here's a pullback from this breakout. We have a small breakout here, a pullback, so a second entry, and now we have a higher low major trend reversal. So we have a bear trend, a trend line break, test near the moving average, lower low major trend reversal, a rally, and now a higher low major trend reversal. Each of these are reasonable buy setups for swing trades. And at the top we have a higher high major trend reversal and a final flag reversal. Final flag, a breakout, and it's a higher high major trend reversal, followed by a lower high major trend reversal. Final flags, when they break out, they do not have to go to a new high. So for example, we have a bull trend, a second leg up in the bull trend, and we have a lot of selling pressure in here, sideways, and we broke out, and then we had a bear inside bar, and it led to a bear breakout. So this was the final flag in the bull trend. The breakout did not go to a new high, so we have a lower high reversal from the final flag. So final flag breakouts do not have to lead to a new high in a bull trend. Here we have a very strong bull trend, channel, and then a very tight trading range occurring after the market had rallied 30, 40 bars or so. So you have to suspect that it could be the final flag in the bull trend. Also, most trading range breakouts fail, and especially tight trading range breakouts. So chances are the bull breakout from this tight trading range will fail. So traders can short this as a final flag reversal. Here's a better setup because here we have a bear bar and then a second bear bar. So shorting one of these is also a reasonable short for a final flag reversal. It's also a higher high major trend reversal. We have a bull trend. You can draw a trend line across like this. The market broke through the bull channel and below the bull trend line by going sideways, and it touched the moving average. And now we have a higher high, and now we have a lower high. So we have a higher high major trend reversal and a lower high major trend reversal. Final flags can also be very small. For example, we have a bull trend and a 2 or 3 bar pullback, and it would turn out to be the final flag of the bull trend. Here we have a gap down and a little bit of a bear trend, and this little sideways price action became the final flag of the bear trend. We have a rally up. This could be a final flag. Now we're up near resistance, yesterday's high. This 1 bar pullback might be the final bull flag of the bull trend, and it was. Here's a trading range now, and we're near the bottom, near this bottom of the channel up. And this little II pattern, inside bar, followed by an even smaller inside bar, it might be the final flag of this bear trend, and it was. And again, a bull flag near the top of the trading range, it was the final flag in the rally. Coming down, this little bull bar became the final flag in this sell-off, leading to a reversal up after a spike and then consecutive sell climaxes. Again, small final flags. Here's a 5-bar tight trading range, a bear breakout that immediately reversed up into a strong bull bar, and this was the final flag in this bear trend. We have a small bull leg in either a trend or a trading range. These 2 bars became the final flag that led to a reversal down to a lower low major trend reversal. Sometimes you can have a very big bear trend like this, and then a small final flag being the last flag in the bear trend. You can argue that this is the final flag, but when we have a new spike down like this, I would start the process over. And this is a very big sell climax occurring after a trend has gone on for a long time. So you have to suspect that it might be a climactic end of the trend, especially since it's down to a support level. Small trading ranges in trends often become the middle of the trend, leading to a measured move down, and that was the case here. So we have a bear leg starting here, and then a trading range, and then another leg. Here's the measured move down. So we're in a support area, and we have consecutive sell climaxes, and we have a 1-bar potential final flag. We have a small 5-bar lower low that occurred in 2 legs. A lot of times the lower low comes in the form of 2 or 3 legs. And then we have a bull signal bar, a bull inside bar. So that's a reasonable buy for, at a minimum, a test of the moving average. Usually, whenever you have consecutive sell climaxes, the market tries to test at least 1 tick above the top of the sell climax. It did not quite reach there today, but it might reach there tomorrow. An II final flag, if you have a bar that's inside the prior bar, and then the bar after it is inside the first inside bar, then you have 2 consecutive inside bars. That's an II pattern, and it's a breakout mode setup. The market can break out in either direction and run in either direction. When you have an II occurring late in a trend, it often becomes the final flag in the trend. So, for example, here we have a very strong bull spike, and we have 3 consecutive inside bars. So this is a breakout mode pattern, and it might end up being the final flag in the bull. It broke to the upside and then tried to reverse down. The reversal led to a bull flag, but it was still the final flag in this bull leg. Here we have a bear trend, a pretty significant bear trend, and then we have 2 doji bars, the first one being inside this bar, and then the second one being inside the first. So it's an II pattern, potential final flag. The market broke to the downside and immediately reversed up, and it had a bull reversal bar. So it's a reasonable long 1 tick above the high of this bull bar. Consecutive buy climaxes. Remember, every trend bar is a buy climax. Every series of trend bars is a buy climax. So each of these green boxes is a buy climax. And now we've had a series of 4 consecutive buy climaxes, and the market is going sideways. So after an overextended bull, now we have a tight trading range, a relatively tight trading range. I did not draw the trend line in, but you could draw a bull trend line here. This broke below the bull trend line and went sideways for 15 bars. That's a lot of selling pressure. It hit the moving average. This is a potential final flag. So traders will watch the breakout from this flag and see if it then has a reversal setup. So we have the good context, but the bears need to have a good signal bar as well. And here's the breakout. It went probably further than what traders wanted, but after this extreme buying and then more extreme buying here and more extreme buying here, it's a reversal bar, even though it has a bull body. Remember, if the bar has a close below the midpoint, it's a reversal bar. To me, this is a reasonable short for a swing down. At a minimum, we should get to the bottom of this bull spike. Probably will come all the way back into the final flag, because that's what usually happens. And after such extreme buying, you'd expect at least 10 bars, 2 legs down. Since the pattern lasted so many bars, 50, 60, 70 bars, I think you'll probably get more than 10 bars down, and you'll probably come back all the way here. So this is a reasonable good sell setup. Again, this is a high 2 buy, 2 legs down, one leg here and a second leg here, and high 2 buys late in overdone bull trends, especially after a series of consecutive buy climaxes, very often become final flags, the last flag of the bull trend. You can also argue that this is the final flag as well. I did not draw it, but this is also a very tight wedge. If you take this push up, and this push up, you could draw a trend channel line above, and this tail broke above that trend channel line, and then the market reversed down. Here you can see the trend channel line, a slight poke above the top of the bull channel, and a reversal down. So you can either short below that bar, or if you want, you can short below a bear bar, especially one that closes on its low tick. At this point, after the market has had 5 or 6 consecutive bear bars, the market's probably always in short, and there should be sellers above. If you take that short below that bear bar, your stop is 1 tick above the high of the bar. You want a minimum target at 2 times the risk, and that's this red line here. So from the entry price to the stop, 1 tick above the bar, twice that distance is here, so you might take half off here, especially since it's at the moving average. And I said that there are probably sellers above after 5 or 6 consecutive bars down after a buy climax, and there were. The market traded down here, and again the final flag here, maybe a smaller one here, and you should get at least 2 legs down and probably more than 10 bars. You'd expect 20, 30, 40 bars after such an overextended bull trend. So first leg down here, lower high, so a lower high major trend reversal. Second leg down, not a particularly good buy. You can argue it's a high 2 buy, 2 legs down, 1, 2, but I think the market's always in short, and we have a lot of selling going on here, so I would not be eager to buy. We're near the top of the channel, the developing channel. You can start drawing trend lines. You can draw a parallel, take this line and put a parallel up here at the high, or you can simply draw a line from this high across these high, and we're testing the top of it, so traders will look for shorts here for another leg down. Final profits on these shorts. This is late in the day, and we've had 3 pushes down, 1, 2, 3. It's reasonable to take final profits above this bull bar after the 3rd push down. You trail the stops. Every time the market makes a new low, you lower the stop to the most recent lower high. The market comes down here. If you're going to hold, you'd lower the stop from this high to just above that high. Again, I talk about this in the modules on protective stops and on trading in bear channels. That's the end of the module on final flags.